U.S.'s invasion there, and sort of this hand-to-hand combat in deeply populated areas that led to a big toll on soldiers' lives as well as civilian lives and didn't lead to resolution. What makes people think that this could be different?
Well, President Biden yesterday mentioned Israel's secret weapon in his conversation with Golda Meir 50 years ago, when we were surprised the last time in an attempt to destroy our state. And he said, we have nowhere else to go. America went into Iraq, into Afghanistan. Ultimately, it pulled out. We have nowhere to go. We're not going to pull out. And the Gaza Strip is just less than a mile from some of our communities. And we have an ISIS-type organization in Israel's backyard. This cannot stand. This will not stand. There's the more moderate Palestinian Authority in charge of the West Bank, and we have a security collaboration and security relationship. So if Hamas is removed, the Palestinian Authority can return. I might remind you that back in 2006, the Palestinian Authority controlled Gaza as well, and then there was Hamas took over, killed through the PA people from balconies, murdered them, and established a dictatorial regime within Gaza. This regime needs to go. It will be painful, it will be hard, it will be costly, but they need to go.
Yohanan, there's been a real difficulty, at least in the public discourse, separating Hamas from the Palestinian people. And in the Arab world, there's also a question about where that distinction starts to get blurred and the support of some of the other nations in the Middle East, including Saudi Arabia, that was previously speaking with Israel. I'm wondering, from your perspective, how closely aligned some of those nations in the Middle East are, or how much they're in communication as this process goes on and as they try to work toward something more peaceful going forward in the future?
Look, there's a big struggle here between moderates and radical jihadists. It's not only an Israeli struggle. Israel is, if you will, a front base of the West, of moderation, of the interest of moderation in this region. If it wasn't for a strong Israel in this region, does anyone have a doubt that Iran would have otherwise become the hegemonic state here and established a dictatorial rule, much more like they do to women in their own country? They would have done throughout the region. This is the attempt. Hamas, while I'm not saying that we don't necessarily have evidence that Iran planned this attack, but Iran pours weapons, ammunition, doctrine, ideology, finance into Hamas. Hamas is an Iranian ally. There's complete agreement about the overarching goal of killing as many Jews and destroying the Jewish state. And as a matter of fact, getting rid of Saudi Arabia and the Emirates and taking charge of the territory and resources. Can you imagine the global economy, global security, if Iran actually implements its will? So it is an Israeli interest to obliterate Hamas, but it is a global and Western and American interest to ensure that Israel does it successfully, and then to restore the dialogue with the Saudis to establish this axis of moderate states. They're also in accordance with the NATO and our Western allies. So there's a big picture here. The big picture is very clear. I'm not concerned at all about the Saudis not understanding it, because their survival is at stake as well. Of course, right now it will be difficult to engage in intimate peace talks, as so many people are going to die. But Israeli policy is not derived from vengeance. It's derived from a clear, rational understanding that it's a struggle for survival with forces, with evil forces, with evil intentions, and we have to be very strong. And I must say, if it's okay to say here, I think President Biden understands it. He came yesterday with a historical speech, and there's bipartisan support for Israel. There's a deep-seated understanding that there's shared values and shared interests. We're going to do our part, and I'm glad that the United States is doing its bit.
Yohanan, thank you for your time today. Yohanan Plesner of the Israel Democracy Institute. A deeply emotional time. Lisa.
Especially as everybody who is in Israel has seen someone called up. Difficult to know how this is going to progress, how this is going to proceed, especially given the ongoing violence.
More than 300,000 reservists called up. More coverage through this morning on Bloomberg TV and on Bloomberg Radio. Your equity market positive here by 0.2% on the S&P 500. From New York, this is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power. Every weekday at 5 p.m. Eastern. Only on Bloomberg. Your global business authority. These CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. On's running shoes have a unique look, and so does its leadership team. CFO Martin Hoffman is also co-CEO, and he thinks two jobs are better than one.
How do you balance those two roles?
I feel the CFO makes you a better CEO, and the CEO makes you a better CFO.
Watch Chief Future Officer today on Bloomberg.
Not selling the Patriots, you're not selling the packaging company. I guess you don't like to sell things, right?
I really don't. We try to create a family environment in everything we're involved in. People want to be part of something that's bigger than themselves.
Investors are lacking conviction one way or another, and I think perhaps key to this will be whether or not this conflict does expand.
When you see rates move at this speed and in this quantity, you always worry that something may fall off the bus.
I think the mindset and the thought process is finally shifting after years and years of low interest rates.
Everybody's worried about their ability to finance.
We're not fully back to where we need to be to say mission accomplished.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
This bond market move is absolutely phenomenal. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Yields down double digits, 2s out to 30s in yesterday's session. This morning, we're down another 10 basis points on a 10-year. Lisa, 455.
And why? Is it just perplexing, as Neil Kashkari says, or is there something real behind this move, whether it has to do with concerns about geopolitical risk or whether it's having to do with this idea that maybe Fed officials won't raise rates again and will take a more dovish stance given that rates had gone up so much, and yet if they reverse too much, that creates a bit of a problem.
It's odd that Kashkari is equally perplexed, but also saying it's possible that rising yields might mean the Fed has to do less. So without any real understanding of why they're higher, they're happy to outsource monetary policy to whatever the bond market's doing?
I mean, essentially, monetary policy uses the bond market as a transmission mechanism. So if the bond market is going in a certain direction, they don't have to understand it if it basically means their credit is going to be restricted, right? I mean, this is sort of the logic behind why the bond market can do the work for the Fed, even if you don't fully understand all of the rationale behind it. I would just take a step back and say what we have heard from Ben Goodrich, what we've heard from others, is that inflation data will reign supreme. At what point, though, right?
Well, the question is whether the market move is doing too much for the Fed or too little. So it does matter the meaning behind it, and I'll explain why. If yields are up because the data's super robust, then the Fed arguably needs to do more, and maybe they can suggest that the market's doing it for them. If the yields are up because of the budget deficit, and there's some kind of concern about financing the budget of the US government, then maybe yields are rising too much, given what the economy needs. They're kind of different things, aren't they?
They're completely different things, and there is no clarity on either of them. So what is the Fed supposed to do, right? I mean, this has essentially been the message. They don't know. They don't control fiscal policy. They watch it. They can think about it. They can have their views. But if they're looking at that as a potential feature, they're looking at inflation data still indeterminate how much it's going to go down and how quickly, and they're trying to come up with some sort of forward guidance. Well, can we just say forward guidance has gotten very muddied, and they're willing to just outsource that too to the bond market?
Based on the logic of the last couple of days, the rate hike in November is back on, because treasuries have rallied so much in 2 days.
I don't know.
4.55 on a US 10-year. More on that without the snark, maybe. I can't promise anything. A little bit later on this hour. Need to talk about a deal. Exxon, Pioneer, the biggest deal for Exxon since the late 90s. Lisa, $60 billion deal between those two companies.
It's interesting that it's coming at a time where supposedly we would be talking about the death of fossil fuels, and it was coming at a time where people just 2 years ago, 3 years ago, were talking about transitioning to electric vehicles more fully, and when gas and crude would become obsolete. No longer, right? And there is this acceptance and desire for energy independence that is new at a time we are seeing record production in the U.S. This gives Exxon an incredible amount of flexibility in the Permian Basin.
The offer, all shared stock deal, $253. Right now trading in the pre-market at $243. Pioneer up by 2.3%. That's the price action. Let's talk about the price action elsewhere on the S&P 500. Equities stacking up as follows on the S&P. 3-day winning streak on the S&P, looking to make it 4. Up a third of 1% here. There's your move in the bond market. Big move. Yields lower. On Friday, cycle highs pushing 5%. Here we are sitting here Wednesday, 455, Lisa, 455.82.
0.25% move in 2 days. How do you start to create a financing plan based on that level of volatility? 8:30 a.m. we do get the latest in real economic data that might serve as some sort of linchpin of a more concrete view. September PPI coming out. The expectation is for some disinflation. Will it be enough to create a calm background for that 1 p.m. $35 billion auction of 10-year notes that will be a test of just how much demand there is in the market today? Fed speakers do line up. Maybe they will all just point to the bond market and say, check out what they have to say, because we can't explain it better than that. Fed Governor Chris Waller, Atlanta Fed President Raphael Bostic, Boston Fed President Susan Collins, and at 2 p.m., in case you want some more information from the Fed, we get FOMC minutes from last month's meeting. Will it be obsolete? Will they give a better sense of how they got to that sort of soft landing projection that some people thought was a bit of wishful thinking? And today we do have at 10 a.m., I believe we will start to see some of the procedures to lay the groundwork for the vote for who will be the next House Speaker. The contest really is between Louisiana's Steve Scalise and Ohio's Jim Jordan. All of the discussion around the U.S. support for Israel, military aid, ongoing military aid to Ukraine, all hinges on having a functioning House. And at this moment, what was it that one Congress member said? It was a 2% chance they would actually come to some sort of easy resolution based on just how contentious some of these discussions
are. Is
McCarthy
making a comeback?
I don't know. Some people are saying maybe he should, because there isn't any kind of coalescing around some of the others. Does he really want to put himself out there again? He hasn't rejected it.
He hasn't. No. He hasn't at all. Still on the table, potentially. Anne-Marie coming up in about 10 minutes' time. Joining us now is Sebastian Page, CIO and Head of Global Multi-Asset at T. Rowe Price. Sebastian, I actually want to start with a quote from the CFO of LVMH, who said after 3 roaring years, outstanding years, growth is converging towards numbers that are more in line with the historical average. Raises the question, when the revenge spend, the post-pandemic boom is over, Seb, what are we going back to?
Look, I think we're not going back to what we used to call the new normal, which was the post-financial crisis environment with low growth, low inflation, and low rates. We just conducted this study of historical regimes, and if you look statistically at where we are, given the macro data, which we have to admit is quite distorted, it looks more like the old normal, so post-80s, pre-Great Financial Crisis environment, or maybe even the post-war boom. The bottom line, one of the takeaways here is that there is oxygen for the economy and markets above 5% rates. In fact, the average 10-year for the last 60 years is about 5.8%. So, Jonathan, I don't think we're going back to the so-called new normal. This is going to be ultimately a very different regime than any of the regimes we've had before. But, you know, there is room for growth. Right now, we're holding portfolios that are broadly diversified. I know it's boring. It's trite advice. But the data is so distorted that now's actually very, very timely advice.
Well, let's get into that. You say it's boring. I actually find it interesting. How can we say the regime has changed, but we're back to the old normal with broadly diverse portfolios? Shouldn't that change too?
Well, look, the equity risk premium is definitely compressed. But let's look at both sides, Jonathan, for a second, right? Growth is surprising to the upside. And we're talking about tactical positioning 12 months ahead. We started the year with 0% expected GDP growth. We're trending towards 2%. We started Q3 with 0.5% expected GDP growth. For Q3, now we're looking at 3%. So growth continues to surprise on the upside. You have strong demand for services. ISM manufacturing are up for 3 months in a row. Fiscal is pedaled to the metal. So I think there's no reason to panic and just go to cash. But on the other hand, and I'm a huge fan of the show, I watch the show every day, everyone's talking about the lagged effects of higher rates and also the speed at which rates have risen. And that is a concern, Jonathan. We have the longest yield curve inversion in history to worry about. And you and Lisa keep asking, and it's the right question, when is it going to start to bite? So you look at both sides, you take into account the fact that the data is completely distorted by pandemic distortions, the level of money, the blob of money in the system, and you sit back and say, now's not the time to be a hero. We're about 75 basis points underweight stocks, but otherwise really close to neutral on total risk.
This raises a question about bonds as a diversifying feature, and we've been talking about that a lot. How can you make the argument that growth keeps surprising on the upside, and we do have all of this fiscal spending and potentially even more down the pike based on some of the conflicts, and then that bonds still are a stabilizing offset to stocks?
So, Lisa, it's a great question. I'm kind of a correlation nerd. I talk about it in my book. I've studied the stock-bond correlation going back decades. And in a nutshell, when you see inflation or interest rate volatility, which we're kind of seeing now, driving markets, you can expect a positive return correlation between stocks and bonds. In other words, they will move together. You get a rate shock, you get an inflation shock, both can go down together, which I think is the spirit of your question. But I continue to believe that when you get a growth shock, or like you're seeing last couple of days, a geopolitical shock, plus there's the Fed talk influencing this, but the safe asset remains U.S. Treasuries and you get a flight to safety. So the question for portfolio diversification is how much inflation volatility are we worried about? And there's other ways to protect against that, to quote unquote hedge that. And how much growth volatility or sort of recession risk are we expecting? And from that perspective, you still have a role for bonds in the portfolio. And at the end of the day, higher rates means higher long-term expected returns for bonds. But this question of what is the role of bonds is really on investors' minds at the moment, Lisa. It's an important question.
So is there a stabilizing feature through both a growth shock as well as an inflation shock or a volatility shock, as you talk about?
Yeah, now you're kind of describing the stagflation environment where you get disappointing growth and still inflation volatility. I do think there is a role. It's really a matter of which variable will dominate. And if you want to balance the portfolio, you can do things like what we're doing currently in our tactical asset allocation, adding real asset stocks and an overweight to real asset stocks, which tend to pop with surprises to the upside on inflation, which we think are still in the cards. So if you have that to balance part of the inflation risk in the portfolio, perhaps some tips, but shorter term tips, cash. Bank loans are really interesting when rates are rising. They're still doing great this year. There's credit risk there, but you can actively manage them. So you put it all together. I'm an asset allocator. I don't like to make statements that one big asset class should be taken out of the portfolio. We should go all the way to cash or all the way to stocks. It's a boring approach, but it's an appropriate approach when so much of the data is distorted.
Sebastian Page, thank you, sir. A new regime, Seb Page there of T. Rowe Price. We mentioned Kevin McCarthy. Here's a quote from McCarthy on Fox News Radio. There are a number of members who want me to become Speaker again. What I've asked them is not to nominate me. That's the official response from Kevin McCarthy, Lisa.
You can kind of understand why he might not want to be renominated after, 15 rounds of votes the first time, and then being the first House Speaker ousted from office. I mean, it kind of creates...
I think it's fair enough.
A little bit of,
Let's not do that.
A bitter taste in the mouth, yeah.
If you're just joining us, welcome to the program. Your S&P 500 is positive by 0.3%. Yields are a whole lot lower, down by about 9 or 10 basis points, 455.82. Just a programming note for us. In the next hour, we'll catch up with Savita Subramaniam of Bank of America on this equity market, who had recently, in the last couple of months, upgraded her outlook on the S&P 500, I think for the second time in 2023. So we get the more constructive view from Savita. Also need an update on the latest in Israel. Lisa, we'll catch up with Anne-Marie in about 5 minutes' time.
Yeah, and we have been getting some sense of how it's evolving, at least in Washington, D.C., in terms of the support being pledged. Still a question, and we keep asking this, of where the linking feature is with Iran, and that is one of the big questions because from a market perspective, that does key into oil prices in a more significant way.
Haven't seen a massive rally there.
No.
Day one, Monday, and then faded pretty quickly.
Which is right now the presiding narrative in markets seems to be this is going to be contained. This isn't going to necessarily percolate out. And there will be some measures that will come in and de-escalate because otherwise you would see a more material move, and it just has not stuck. The only move that's stuck is in the bond market.
That's taken the temperature, I think, of one question, whether Iran is directly implicated in what took place over the weekend. Don't you get that feeling based on the moves we've seen?
Basically the fact that Israel and the U.S., to build on that, have it come out and said Iran was directly involved. And if they haven't done that, if they're not going to get directly involved, it just takes some of the potential heat out of the pressure there.
More on that question up next on this program. Bloomberg's Anne-Marie Jourdain in Washington, D.C. Live from Washington, next.
Through the noise. Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
The top names in global leadership are on Bloomberg.
Right from the start, I decided to open our border and to take in millions of refugees from Ukraine. We believed, and we still believe, that it is necessary, and we try to serve as neighbors should do.
If we want peace, if we want a negotiated outcome, strengthen Ukraine on the battlefield, because that's the only way to convince Putin that he will not win on the battlefield.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
When Congress returns, we're going to ask them to take urgent action to fund the national security requirements of our critical partners. The United States has also enhanced our military force posture in the region to strengthen our deterrence, and we stand ready to move in additional assets as needed.
The President of the United States speaking on the Israel-Hamas war, addressing the country and the world just yesterday. From New York City, welcome to the program. Plenty of price action to talk about elsewhere on the S&P 500. Three-day winning streak could well become 4, up a third of 1%. The fate of this rally may be in the hands of the PPI data a little bit later this morning. Lisa will get that information in a little more than an hour. Then it's on to CPI tomorrow. And then we can start talking about earnings. Start talking about earnings, which have kind of crept up on us over the last couple of weeks.
Do you think that the PPI and CPI data is going to be more important, or JP Morgan earnings and all of those that come subsequently?
Don't know. Don't know. I really don't know.
Because right now it feels like there are so many questions that are embedded in some of the economic data that's backward looking, and the forward looks from some of these companies that have been upgrading their estimations for their own businesses might provide more of a compass than some of these lagging economic indicators.
So the banks finance the economy, and if the banks are struggling to do so, if they're constrained by what's been developing in the bond market, that's worthy of interest. I find the earnings from Bank of America perhaps more interesting than what we're going to hear from JP Morgan on Friday. B of A has had a terrible year through 2023. Their stock is down by something like 20%. So we're not talking about regional banks. We're talking about Bank of America down 20% on a year where the economy, we're told by everybody, is doing better than good, better than expected, that's for sure. Rates have been high, which is meant to help them, but it's been hurting them, and hurting them big time if you're looking at the stock.
RBC Capital's Gerard Cassidy put out a note this morning where he basically was saying he's looking for credit deterioration, which he's expecting to see some of. At what point does that lead to what you're talking about, real weakness that you're seeing in the share price of Bank of America that hasn't yet been reflected in the mainstream feeling about where we are in terms of credit retreat from the global economy?
This at the moment is just absolutely nothing compared to what we've got to talk about next. Looking at some of these numbers and still trying to get clarity on certain issues, just allow me to work through some of this. Israel Defense Forces spokesperson said the overwhelming majority of the 1,200 Israeli fatalities were civilians. We're still trying to get clarity on so many different things. The number of civilians, the number of people missing, particularly from America, their questions being asked of this president. How many are still being held hostage? I have to say that in an interview earlier on today, a reference was made by a Bloomberg anchor to the alleged mutilation of babies, which is an absolutely shocking story. We should make it clear that these are unsubstantiated reports, and we apologize for that error, but seeking clarity on some of these reports is a big, big deal for us over the next few days. Anne-Marie joins us now, our Bloomberg Washington correspondent. AMH, how on earth do we get clarity on those kind of things?
Well, right now, Jonathan, what we're witnessing is this fog of war and a ton of confusion, as you do have the IDF, the Israeli Defense Forces, going in, trying to figure out, going into people's homes. Those people are no longer there. What happened? Who is missing? Are they dead? Were they taken hostage? There's a number of questions that are happening. There's a ton of reports that are coming out of southern Israel, as well as what is going on in Gaza, and it's going to take weeks, if not months, to really try to understand the devastation and travesty that was done here. And when it comes to tracking down these individuals, you know, this is going to be really a global effort, because there were other nationals there besides Israelis. We know Americans are missing, but the U.S. can't even say how many we think are taken hostage. We just do know a number are missing.
John and I have been talking about how there's been really delicate messaging around the involvement of Iran, particularly from the U.S. and Israel, and how that will determine the involvement there. We did hear from Janet Yellen's Treasury Secretary earlier this morning that the idea of more sanctions is on the table. Where are we in terms of understanding how far that investigation into Iran's involvement is from the U.S., from Israel?
Well, it does seem like the intelligence services are trying to go back and figure out what the direct link was. It is a very difficult line for the United States to walk, frankly, because you have to say that on some level Iran was complicit for their decades of support of Hamas, which the U.S. designates as a terrorist organization, complicit in terms of helping them manufacture arms, the amount of cash they support Hamas with, and the training that they give to this militia, again, that the U.S. designates as a terrorist organization. So on one level, the United States has to say they are complicit. At the same time, you're finding it very difficult for an official to come out and directly link the weekend's massacre to Tehran directly. And part of that reason, of course, is if Iran is directly implicated, Israel is going to be compelled to attack Iran. And I'm not just talking about deniable missile attack here or there or cyber attack, compelled to attack in a very public, forthright way. And then that, of course, risks a broader regional conflict with Iran, a major state actor, at play.
There's also a question, Anne-Marie. President Biden talked about additional aid to Israel and providing munitions and additional support. Where is the financing going to come from if there isn't some sort of speaker determined by November 17th?
Well, already, I believe the New York Times this morning is reporting that alongside Antony Blinken touching down in Israel, we will see the first tranche of weapons being delivered to Israel. There's a number of drawdown methods and money already appropriated that the U.S., the president can draw upon to send to Israel. But yes, he did call for the fact that when Congress is back, there's going to have to be more money for the intelligence and security of our partners. Notice the president used the word partners. Right there in that moment, he was linking Ukraine aid with Israeli aid. What we know is that the Senate is ready to move on this. There's a tremendous amount of bipartisan support in Congress, on the House side and on the Senate side, to make sure that Israel is given this aid and that the U.S. is standing with Israel. Of course, there's the issue of the fact that there's no Speaker of the House at the moment, but the pro temp Speaker, Patrick McHenry, did insinuate to Politico yesterday that if the government needed to act, he could. So there is a way potentially for Congress to give him the power to bring a critical piece of legislation on the floor, even though at this moment he's acting as the interim speaker and they have yet to decide on their permanent Speaker of the House.
Anne-Marie, there was a sense on Monday morning, after these shocking images over the weekend, that we would get a sense of urgency out of Washington, D.C., that maybe we'd even see a change of course, a change of approach to making policy, and start to do something about the dysfunction that has plagued the nation's capital for much of this year and for a whole lot longer. Do you sense that still this morning?
I think there is this feeling that they want to act and get it together. The issue is this party, the Republican Party, has such a slim majority in the House of Representatives, and they're just too divided at the moment to coalesce around anyone. What we heard from Congressman Tom Massey of Kentucky coming out of yesterday's caucus was there's a, quote, 2% chance that today they will know who their next speaker is. Today they'll be taking a blind vote, and when they meet this morning, this is Republican caucus, and he says there's a 2% chance. So that says to me that this family has a lot of issues to work out, and we're not going to see that anytime soon. Even though when you talk to people and you hear what they say to the press, they want to act, they want to move past this, they want to get legislation to the floor. But it's just too divided, and the majority is just too slim for them to be able to coalesce around any individual at this moment.
Anne-Marie, appreciate the update. AMH down in Washington, D.C., our chief Washington correspondent. Do you think that the odds of electing a speaker are higher based on the events we've seen? A sense of urgency, the odds of a shutdown are lower? Terry Haynes Pangaea, caught up with Terry yesterday. You're wrong. Just flat out, you're wrong. He does not think it's going to change that at all.
And that's certainly what we saw overnight, right? That's what we saw with respect to the wrangling and the lack of coalescing around a particular candidate. That said, one of the key swing factors here is at what point will Democrats want to help out in some way and not just vote for Hakeem Jeffries and try to facilitate the next speaker in some way by cutting side deals. A lot of people think that that actually might be one of the determining features going forward.
Lots still to talk about this morning. We've got a big deal in the oil patch, a $60 billion tie-up between Exxon and Pioneer, $2.53 per share, all-stock deal, the offer for Pioneer. That could close, and we could have an absolute monster in the energy patch. Exxon, potentially, with the biggest deal going back to 1999. I say potentially, Lisa, because we're still trading at $2.43 in the pre-market for Pioneer.
You can always sort of count for some risk, some tie-up risk, but still, it seems like people are baking this in, and then the question is, who's next?
Who is next? Who's going to strike a deal that big? I don't know if anyone's going to strike a deal that big. Coming up, Kathy Jones, Charles Schwab on a big bond market rally.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
3 days of gains on the S&P 500 could well become 4. Day 3, the longest daily winning streak on the S&P 500 going back to late August. Day 4, equities up a third of 1% on the S&P. Futures higher on the Nasdaq, up by 0.4. The Russell, the small caps, doing okay, up by 0.2%. Talked a lot about the sector outperformance we saw yesterday. Utilities, discretionary, the kind of things that were getting beaten up by higher yields, taking some comfort from lower yields. Let's see if they do that again today. 2-year, 10-year, 30-year. Let's break it up as follows. The 10-year right now, 456, down 9 basis points. The cycle high on Friday, 488.52. The 30-year right now, 472.67, down 10 basis points. The cycle high on Friday, 5.05%. And by the way, we were closed on Monday. So these moves, Tuesday and this morning, they are monster moves, Lisa. Double-digit moves at the long end of the curve, 2 days in a row.
Which makes me think, what's behind this, right? I mean, is this something that's technical? Is this someone being squeezed out of positions? Is this something fundamental that has to do with the haven demand or has to do truly with Fed speak? I don't know the answer. I don't think anyone does. Even Neil Kashkari, he finds it perplexing.
And last week, I think we had double-digit moves 2 days in a row in the other direction.
Exactly.
So go figure.
Exactly, which raises the question of structurally what's going on in a bond market that has been the most liquid, deepest market in the world. What's going on there?
What is going on? I'd love the view from the rest of the world. So we have the IMF World Bank annual meetings taking place over in Marrakesh, Morocco. TK, as I'm sure many of you know, has got on the plane. He's just messaged me a moment ago. Did you get the picture message?
He arrived.
With a picture of a camel and someone in the desert who isn't
He's
Tom.
not Tom Keane.
It's not Tom.
He's definitely not riding a camel.
I'm not sure if Tom fits on a camel or not.
I'll leave that
we'll
there.
see. TK can have a go a little bit later. Tom's going to catch up, hopefully, with the ECB President, Christine Lagarde, a little bit later on this week. So we'll get some questions. I'd love an international perspective on the move we've seen in treasuries.
And how difficult it makes their job, because when the U.S. Treasury market is flipping, flopping, you see that the rest of the world is moving along in tandem. It kind of muddies a message at a time that's really, I would argue, more fraught for Europe right now than the U.S., especially with people saying that, you know, the U.S. strength is unique in just how persistent it is.
Let's take a look at Europe and Christine Lagarde's euro. The euro against the dollar shaping up as follows, just in and around 106. Broke that a little bit earlier again. Seen that a couple of times in the last few days. 105.98. We're negative on that currency pair by about 0.07%. Under surveillance this morning, the death toll from the Israel-Hamas war rising past 2,000. The Israeli military reportedly responding to missile strikes from the Iran-backed Hezbollah across the border in Lebanon. Prime Minister Benjamin Netanyahu and opposition leader Benjamin Gantz are in current talks to form an emergency government to focus on security challenges. This was a question we were asking Monday morning and through the weekend, Lisa, whether those security challenges go beyond the Gaza Strip, where you have to start being concerned about what's happening in the north with Lebanon and Hezbollah coming down.
And there have been a number of reports about rockets being fired. It hasn't seemed to move into the escalation phase. Interesting, though, at a time heading into this where there was really unprecedented debate and clashing within Israel itself and the government about what kind of rule they want, right? A lot of protests to Netanyahu's rule. There's a question now, okay, coalescing around emergency government, how that factors into what happens next, especially given some of the dissents that we heard earlier.
But to be clear, the bond market rally that we've seen, one part risk aversion and two parts this, the Fed speak that we've heard over the last couple of days. The San Francisco Fed President, Mary Daly, saying on Tuesday, a 5% policy rate is not the new neutral, but we may have to live with higher rates than before the pandemic. The rise in yields may also be doing the work for the Fed. Bond yields have tightened meaningfully. Financial conditions have tightened, depending on whether it unravels or whether the momentum in the economy changes. That could be equivalent to another rate hike. You caught up with Mary Daly. It's a repeat of what she told you, Lisa, last week.
And what she also said is markets hate uncertainty. People hate uncertainty, and this is uncertain. So what guidance can she give? She said, you know, honestly, uncertainty is a policy choice. Inaction is a policy decision, because right now, at every meeting, they are taking active decisions given the uncertainty. And the fact that she's parsing through, you know, the different anecdotes, which she doesn't call anecdotes, she calls them qualitative data because she quantifies them in a more material way. But that also is part of what's factoring into how she's picking up where we are in the cycle.
They're anecdotes.
They are totally anecdotes. She said that it's different. She went off on this because, you know, I said, you know,
I'd love
about
to hear
Patrick.
that one day.
Well, no, but okay, well, we cannot do it now. That's what I gather.
We'll skip that today.
Yes, exactly.
Get some Fed minutes and a load of anecdotes a little bit later. 2 p.m. Eastern time. Look out for that. Want to finish on this. Big deal for American oil. ExxonMobil agreeing to buy Pioneer Natural Resources for nearly $60 billion at $2.53 per share. This marks Exxon's largest acquisition since merging with Mobil all the way back in 1999. It also puts Exxon in position to become the dominant producer of shale oil in the Permian. Tune into Bloomberg TV, 9:40, an interview with Exxon CEO Darren Woods, Pioneer CEO Scott Sheffield, Alex Steele catching up with both of them. Darren Woods wanted something to buy. Scott Sheffield was retiring and perhaps was looking for something to sell. It's a match made in heaven, Bramo, for American oil.
The timing is interesting, though, especially when oil is such a focus when it comes to where that's going to play with respect to inflation, as well as, you know, the U.S. and their independence, given some of the concerns internationally. The fact that you have one major player suddenly in the shale patch suddenly might be more amenable to regulators and to all of the others in the U.S. if that is a more desirable goal than it was, say, 2 years ago.
Looking forward to that interview, those conversations in a couple of hours' time on Bloomberg TV. Look out for that on Bloomberg Radio. With us around the table here in New York, Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, wonderful to catch up with you. We spoke to a guest yesterday, Charles Cantor of Neuberger Berman, who said that bonds are contracts and equities are stories. I don't want to talk about stories in the bond market. I want to talk about price action. The first 2 days of last week, we had something like double-digit moves, yields higher. And then the first 2 trading sessions of this week, we've got double-digit moves, yields lower. What do you make of just the magnitude of the intraday moves we're seeing in the bond market?
I think Lisa touched on it. The liquidity is not what it once was. But we've also had, you know, we're sort of on this cusp of how high is high, right? We keep hearing from the Fed that, well, we might be there, we might not be there. And we've had a number of, you know, mixed messages. But there's a lot of narratives, as you say, a lot of stories going around that it was supply, which I think is not probably a good explanation, because we always have supply and we always know when that supply is coming, and I don't think anybody woke up yesterday and said, oh, we have a rising deficit, right? We had some stronger than expected economic data, that blowout jobs report in terms of the numbers, but with low wage growth, so sort of offsetting it. And I think that you have this, you're talking about uncertainty, that drives up the term premium. It's highly correlated with volatility. And so there was just a lot of questions, a lot of stories going around, and a lot of people trying to get an explanation.
There are 2 ways to interpret this. On one hand, you have an interpretation that the volatility might mean that something could break and that it makes things more vulnerable. Or you could say the volatility has been incredible and nothing has broken, which highlights just how resilient the market is. Which take do you take?
I guess I would be more concerned that there's still some things that could break, not looking for a big explosion or something, but you can't have this high a level of real rates, this rapid an increase in rates, this tightening in financial conditions under the surface, not just, you know, if you look at the spread data, maybe it's not so much, but when you look under the surface at what's happening with tightened lending standards, with what's happening with bankruptcies at smaller firms, you're starting to see some cracks. And I think that's also what's being reflected in the Fed speak. You know, one of the things I do when the Fed's reports come out, their regional indices, is read the comments. It's a treasure trove of anecdotal data. And I think that they're probably reflecting a lot of the comments coming out from the businesses in their districts saying, hey guys, enough. You know, commercial real estate's a problem, financing's a problem, car sales are a problem. We're running into those sorts of things. And I'm guessing that some of the shift in the Fed speak is a reflection of what they're hearing on the ground.
If the Fed does hold off on raising rates an additional time because of how much rates have gone up on the long end, is that good or bad for longer-term bonds? I mean, all things being equal, if you believe in the economic data, then wouldn't that mean that longer-term yields should go higher because it allows the momentum to actually pick up all that more?
Well, I think if you believe that the lagged impact is still working, which is what we're hearing from a lot of the various Fed speakers right now, Bostic and Lori Logan, et cetera, saying, you know, we haven't felt the full impact of this, then you don't need to have the long end rally that much, or I'm sorry, rates move up at the long end that much to continue this constraint. But the question is, you know, have we hit peak? And if we have, does the yield curve then disinflate because we anticipate lower rates going forward rather than higher rates going forward?
What's the signal of weak growth here? The bear steepener or the bull flattener? Because traditionally, I used to be told it was the bull flattener. That was the market pricing out growth.
Right.
And now we're welcoming the bull flattener in bonds, and we're scared of the bear steepener. Does that make sense to you?
No. I would say you want, when it disinverts, you want it to be because rates are coming down at the short end, not because rates are going up at the long end. They do tend to converge at the peak. You do get this flattening out at the peak, but it's usually with short rates coming down. So it doesn't make a lot of sense to me that if you're going to make a weak economic growth call that the steepening is consistent with that.
So I'm with you on the anecdotes. We spoke to Patrick Harker at the Philadelphia Fed in Jackson Hole. I remember precisely what he said. He's been hearing from people in his region, in his district, that are basically saying they've gone far enough. Hear those complaints all the time. So with that in mind, when we get the Fed minutes a little bit later, how does someone like you read those Fed minutes? Are they dated? Do they mean anything?
I do read them just because any small changes in the wording will be significant. And I try to find out, is it several, is it a few, is it a lot? All those key numbers of how many people at the Fed feel this way or that way. But it is somewhat dated at this stage of the game, too. It's not, it's already, once you're 3 days out from the Fed, it's over.
The Fed speak from a couple of days ago is dated based on the moves we've seen in just 2 trading sessions. In fact, it's not even 2, is it? It's like 1 in a few hours.
1 in a few hours. 1 in an overnight session that tends to be volatile.
Just absolutely ridiculous. Kathy, thank you. Kathy Jones of Charles Schwab. Just the latest here from UBS. Just want to give you a banking update on how some of these institutions as businesses are responding to the tension in the Middle East. UBS has imposed a work-related travel ban on its staff within the Middle East. They've also postponed a wealth management event that was due to take place in Qatar this month. So, Lisa, just to repeat that, UBS imposing a work-related travel ban on its staff within the Middle East.
You can imagine that there are probably adjustments happening across the board, because you have to think Israeli staff are being called up to the army in mass numbers, the working age men and women. You have to think about a whole host of different ways that different companies are trying to rearrange some of their plans.
We'll see how other financial institutions and businesses respond to the developments over the weekend and through the next week, months, and who knows how much longer for. If you are just joining us, welcome to the program. On the S&P 500, we are positive here by 0.3%. Yields are lower, a whole lot lower, by 8 or 9 basis points. The 10-year, 4.5644. Let's go through those numbers again. What we saw on Friday and what we see on the screen right now. On Friday, high of the session, high of the cycle, 488.52. We're back down to the 450s. That's the 10-year. On the 30-year, through 5%, we've done that a few times, 5.05%, the cycle high, session high on Friday's session, and we're all the way back down, Lisa, to 473.31.
Kathy Jones said something really profound, which is that this is volatility in term premium, which happens when you get this sort of uncertainty, and this tends to happen. And all of these moves really have been driven not by inflation expectations, but by term premia. And so it raises this question of, well, if we get this kind of volatility, if we're in a prolonged period of uncertainty, couldn't we get higher yields throughout that period, whether or not you have an economic justification for them?
I've been looking forward to this conversation, Lisa, Dilip Singh of PGIM, because he's been talking about that, the loss of predictable demand in the bond market. That's something we need to discuss as well. Are we talking about a change of the buyers? Not demand strike, just a change in the nature of where the buying comes from.
That's what people think, just because you have Japanese investors who can go back home and actually get some yield. The idea is not just, are there enough buyers? It's, are there enough price-insensitive buyers? That is the distinction that I think really needs to be drawn.
That's the major change in the last couple of years. QT, China pulling back to some extent. That's a conversation we'll have next. Dilip Singh of PGIM Fixed Income, just around the corner from New York City. Equities higher from New York this morning. Good morning.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Next week on AI IRL.
I do think it has a tremendously positive effect on democratizing technology. I mean, just imagine what it must feel like if you are a country in Latin America, Sub-Saharan Africa, or in other parts of the world where you just don't have either the money, because you need a considerable amount of money, or the very significant GPU computing capacity, or the data to build any of all of these things.
If it turns into a wider conflict, say, and that causes oil prices to go up, that does have an effect on the economies. When you look at the numbers, suppose oil prices, say, went up by around 10%, then about 12 months later, you see inflation going up by around 0.4 percentage points. Global output is lower by about 0.15 percentage points. So it can have these kinds of effects, but again, it's too early to tell exactly what's going to happen.
That was Gita Gopinath, the IMF First Deputy Managing Director, speaking with Bloomberg's Francine Lacqua at the economic impact of the Israel-Hamas war. Francine Lacqua at the spring, or rather annual, World Bank IMF meetings in Morocco. TK is going to be over there. I understand in a few hours' time he's going to get to that conference and, you know, Tom gets settled.
Yeah.
Do a nice conference, do a couple of panels, and fly back and maybe have a vacation along the way.
Hopefully we can get some pictures. I would like to see where he peruses and whether he really starts to absorb the culture.
Agreed. At TK, we'll get a phone interview with Tom over the next couple of days. don't know if you do. Dilip Singh of Pigeon Fixed Income weighing in on the Israel-Hamas war, writing this: national security experts debating whether the US has sufficient throughput capacity to back Ukraine, Israel, and possibly Taiwan in a simultaneous and extended conflict scenario. The unanimous and emphatic answer from experts is no, which underscores the likelihood of a period of fiscal dominance in which deficits are mostly disregarded and interest rates must adjust to a higher equilibrium. Dilip Singh, the chief global economist and Pigeon Fixed Income, joins us right now. Dilip, wonderful to catch up with you, sir. What a difficult time. I'm going to lean a little bit on your experience in the administration along the way in this conversation as well. Paul Tudor-Jones caught up with a regional business news network called CNBC in the last 24 hours. You might have heard of Paul. I'm not sure about the network. Dilip, this is what he had to say. He said he's never seen this kind of geopolitical tension in the last something like 50 years with the deficit position, the budget position of the United States this week. Dilip, how important is that?
He's right. The backdrop is we've returned to the most intense period of great power competition in at least 3 decades. That's going to mean more demand on fiscal spending to shore up our sources of competitive advantage. And you know, it's also the reality that we're seeing a surge of yields driven by term premium because bond investors, they don't know whether we're going to grow fast enough, whether tax revenues will be high enough to service a rising cost of capital. They don't know whether other buyers are going to show up at auction, and they don't know whether Washington, D.C. can exert enough fiscal restraint if growth falters. And that's why you're seeing this repricing. It's a very challenging time.
Dilip, you wrote this column that we found fascinating, and we've cited quite a bit, about the lack of price-insensitive buyers really questioning the ability for the U.S. to borrow at some of the rates that they were accustomed to in the past. Can you just bring that forward to today's moment with increasing calls for military aid? How much does that actually make you double down on this idea of borrowing regardless of where rates are in order to finance national security and other concerns?
Well, Lisa, here's how I synthesize what's going on. There are 3 fundamental dynamics. What's the Fed's near-term reaction function? What's long-run neutral? And what's the term premium? And then you have to overlay the impact of the attack on Israel. on the Fed's reaction function, I think Lori Logan said it best. When we have a higher term premium, all things equal, implies a softer economic outlook and greater likelihood that the policy rate has peaked. Okay, on long run neutral rates, I think what we're seeing, with payrolls and lots of other evidence is that something really positive is happening on the supply side of the economy. That's how you can get above trend growth alongside disinflation. So long run neutral rates are going higher. Then you have term premium. We just spoke about that. The balance of risks are still moving higher. If the house is in disarray, that means no durable fiscal consolidation is on the horizon. And therefore, you have a durable risk of a supply-demand imbalance. The Fed is no longer showing up at every Treasury auction. Neither are large overseas buyers to the same degree, either because their savings balances have fallen or because they want to diversify their holdings. And now overlay the impulse of the attack on Israel. It's another injection of uncertainty. It's another potential supply-side shock on energy prices. And the net of it for me is you do get a higher drift in long-term yields with an anchored front end.
So based on what you're saying, Talib, do you think that the move that we've seen, barring the past couple of days, in longer-term yields makes sense, or that it's not high enough, or that it's gone a little bit overboard?
Well, Anne-Marie said it right. Right now we're in the thickest fog of a hideous and tragic war. And so we're seeing a flight to quality on the back end of the curve. But I think over time, as market participants think through the second and third order effects, the forces that I mentioned are going to cause a drift higher. And the front end, I think that's where I have the most conviction at this point. I think the Fed has said now with a chorus of officials, we're going to let markets do the work for us. And if the data continue to moderate, both on growth and inflation, we can watch and wait.
Dilip, I just want to finish on a potential policy response. And this, I think, involves your experience in the administration. What kind of sanctions response should we be looking out for as a team, for the investors listening to this program right now? What would you expect to see from the administration, the White House, in the coming weeks and months?
Well, the leading edge of any response from the administration, if it proves necessary, will be in the military realm. That's why you see 2 aircraft carriers moving to the Eastern Med. That's why you see all of these efforts to shore up Israel's Iron Dome. There will be a sanctions component because money is fungible. To the extent that Iran is seen as directly involved in the planning and execution of the attack, I think you'd see the screws of sanctions tighten. That would be a global effort. But that's second order to the military response.
Dilip, much has been said about the sanctions response and the fact that perhaps this administration turned a blind eye to Iranian crude production and perhaps Chinese buying off that crude. What's your view on that?
I disagree with the premise. I know there's a lot of hype about the $6 billion. The administration's spoken pretty clearly. Not a dollar has been sent to Tehran. I would be shocked if a dollar ever moves to Tehran in the aftermath of this attack. And so, there is going to be, I think, less and less Iranian crude oil on the market. The question for the administration is, can they get an offset from Saudi, from other sources, from domestic producers? That's going to be the challenge.
So, Talib, you just said that you think that refreezing that $6 billion is pretty much a certainty at this point. Is there a potential ramification? Does this have any kind of play into some of the accusations of using a dollar as a weapon, or any of these talks that have really flared up a couple of years ago?
I don't think so, Lisa. If we're talking about the barbaric invasion of Ukraine or this hideous attack on Israel, there have to be consequences. And when you stop short of deploying your military, economic tools are the second best resort. So that's what we're seeing. I don't think it's a threat to dollarization. We're going to move with our allies, and we're doing so to uphold the principles that underpin peace and security across the world. That's good for the world. That's good for financial markets. That's good for the economy. That's what these sanctions do.
Dilip, don't be a stranger. It's great to catch up with you, sir. Hopefully we can do that again soon. Dilip Singh there of PGIM Fixed Income. On that $6 billion that's been talked about so much over the last couple of days, I'll go back to what Secretary Blinken said, that it is very carefully and closely regulated by the Treasury Department to make sure that it's only used for food, for medicine, for medical equipment. You have to imagine at this point, never mind refreezing it, are they ever going to allow a single dollar to leave that account?
Dalip Singh there saying he can't imagine that they will, right? Because if you imagine, even if it's going to aid, it's dollars that Iran doesn't have to spend out of their own money for that same type of aid. This is the argument that people have been making. Regardless, John Kirby said yesterday that no determination has been made yet. They are looking at that. But given how much pressure there is on this administration and just generally, regardless of what they find in the details of Iran's involvement in the attack, it seems like there is enough, as Dalip was saying, that they are going to refreeze that $6 billion.
A couple of updates this morning. This from UBS, just a business response. Logistically speaking, day-to-day business for banks like UBS and what this means after the weekend's events. UBS imposing a work-related travel ban on staff within the Middle East and postponing a wealth management event that was due to take place in Qatar. I find it interesting, Elisa, not just Israel. This is across the Middle East, including a place like Qatar.
But this raises the question, right? At what point does this escalate in the unpredictability of a potential escalation? Why would a company put people in the potential of harm's way? Also, you have to imagine there are people who are canceling. You've got to imagine that there's some people who don't really want to be traveling in a region where there is a feeling of instability. We've already seen a whole host of airlines cancel flights to Israel in particular. But again, you know, if you're in that region, there's probably some hesitance.
We'll see if we get more of that in the coming days. Just to get you set up for the next hour, this is what it looks like. So at 8:30 Eastern Time, about 34 minutes away, PPI data in the United States of America. 24 hours after that, you'll get CPI data in America. They're the two big data points going into Friday when we get bank earnings. At the moment, equities higher by 0.3% on the S&P. 3 days of gains could become 4. Yields a whole lot lower. We're down 9 basis points on a 10-year.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat-trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd! Carly Lloyd! Ladies and gentlemen, we have an American hero.
I had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
These CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. ON's running shoes have a unique look, and so does its leadership team. CFO Martin Hoffman is also co-CEO, and he thinks two jobs are better than one.
How do you balance those two roles?
I feel the CFO makes you a better CEO, and the CEO makes you a better CFO.
Watch Chief Future Officer today on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
The market takes out the human factor and the horror and looks at this in a much plainer, cold-hearted light.
There's just so much bifurcation underneath the market.
The Fed is not going to adjust policy based on a temporary move in headline prices.
Guys, it's a generationally levered system. Higher for longer isn't good.
At this point, solid would be, we don't go into recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I say this all the time, we shouldn't have favorites, but Tony Dwyer
100%
is in the mix. He is a favorite from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P 500 positive here by 0.3%. It is a 3-day winning streak on the S&P, the longest going back to late August. We could make it day 4. It's held out by this big move in the bond market yesterday, 2-year, all the way out to 30-year bonds. Yields lower by double digits this morning. We're lower by 8 to 457 on a 10-year. This hour, inflation data out of the factory gate. PPI data at 8:30 Eastern time. On to tomorrow, Bramo, consumer price data.
Which may give a little bit more of a compass, as we've been hearing from people, that could underpin some of these moves with a little bit more fundamentals. How interesting that typically we've always said that stocks were the more volatile asset class and that bonds sort of got carried along for the ride. I would argue the tail's wagging the dog in every which way it has been, and I could say that what we've seen over the past few days, even more so. Even on days when bonds weren't open, then stocks were less volatile. Bonds get open in terms of the market.
The bonds the dog or the tail?
I think that bonds are... That's a good question.
Just trying to figure it out, Bramo. Let's make sense of this.
Okay, that's true. Okay, I think probably the bonds are the dog, because I think they're probably the main thing. Right. They're the ones that look at the balance sheet rather than the stories.
TK's not here. Someone's got to screw up this program, right?
so it's going to be you.
Disrupt things.
Well, there you go. You did a great job.
30-year down by about, down by about 9 or 10 basis points on a 30-year. It's quite phenomenal. You talked about it. You referenced it. I know, and I'm with you. Yesterday, we saw double-digit gains. Treasury yields lower, or rather double-digit losses on the yield. Last week, the opposite, the total opposite. How much has changed in between? If anything, we had really strong data on Friday in the payrolls report.
But what we just heard, and this I think that Kathy Jones said, is it is a lack of liquidity. It is also a lack of certainty on such a profound level. And in times like this, she was saying, typically that increases the term premium. When do we get more certainty? Are we going to get it with PPI out of the factory gate, as you mentioned, in about a half an hour time? Are we going to get it with CPI? Are we going to get it with JP Morgan earnings and all of those that come subsequently? The picture is muddied. It is a difficult moment to really capture. And this is typically what happens at tipping points in the economic cycle. So if you do get this kind of whipsaw action in bonds, does that lead to a consequence independent of some of this other economic data?
Let's talk about some company news. You mentioned the banks on Friday. JP Morgan results just around the corner. LVMH delivered yesterday. The post-pandemic luxury boom is over. They've basically called that. We can talk about that all morning. Let's take a look at Exxon and Pioneer in the pre-market. Exxon delivering what could be its biggest deal since the 1990s, 1999 with Mobil. Now looking at Pioneer at 1.9% in the pre-market to about 242. They're going to pay $253 per share, all stock deal, according to the statement we saw this morning. Lisa, $60 billion agreement.
It would be the largest corporate takeover deal announced so far this year globally, just to give you a sense of the scope and scale of what we're looking at. And it comes in one of the hottest areas for investors after so many years of people shunning the oil complex. At this moment, it is interesting that this is where we're seeing massive deals. And the biggest questions are not, why is this happening now, but who is next? at a time when people would like to see more consolidation.
Just a programming note, in about 1 hour and 35 minutes, Alex Steele catching up with both Darren Woods and Scott Sheffield. Woods of Exxon, Sheffield of Pioneer, a conversation you do not want to miss a little bit later. Let's turn to the price section. Your equity market on the S&P 500 shaping up as follows. Positive here by 0.3%. A lift in this equity market, even with Friday's blowout jobs report. Equities gained on Friday. They gained on Monday. They gained on Tuesday. Let's see if they can gain this Wednesday. The bond market yields lower by 8 basis points at 457. Our top story this morning, Israel, Hamas, the war continues. Anne-Marie Hordern, our Bloomberg chief Washington correspondent, joins us from the nation's capital. AMH, what are you looking out for today?
Well, today, Jonathan, we have an update on the president's schedule. So this does seem that the White House wants to make sure that the president is outspoken in the days ahead when it comes to the atrocities that happened over the weekend. And now as we see a war reciprocate on the Israeli side. So the president will be stopping at a roundtable with Jewish community leaders, and he'll be delivering remarks there. We should also note the president yesterday alluded to anti-Semitism. He talked about how this attack brought to the surface painful memories and scars left by a millennia of anti-Semitism and genocide of the Jewish people. So I think you're going to continue to see this outreach to the Jewish community here in the United States from this president. He's going to want to continue to talk about what he called yesterday the unwavering and ironclad support from the United States to Israel.
Anne-Marie, how much are the president's hands tied based on the lack of a speaker in the House?
Well, the president is able to use other methods to make sure that Israel is getting some support and protection immediately. There's reporting that the first tranche of ammunition is already arriving in Israel today. You know, the most important thing is going to be to replenish the Iron Dome, those interceptors that the Iron Dome needs in the anti-missile system to be able to function. And also, they quickly and swiftly moved the USS Gerald R. Ford to the eastern part of the Mediterranean. And we heard from the Joint Chiefs of Staff come out and say that that was to deter Iran. And we should make no mistake how big of a force that is and a statement that is for the wider region. So that's already what the president has done. Yesterday, of course, he did come out and he said when Congress is back in session, he is going to make sure that the national security concerns of our partners are addressed, and he's going to push Congress to act. So with the term partners, that's linking Ukraine aid with Israeli aid. And yeah, obviously, it's very difficult when the House of Representatives is speakerless. They're at an impasse right now. But Patrick McHenry did allude that if the government needed to get something done, they would be able to do it.
Just quickly, Anne-Marie, how united is the Democratic Party behind President Biden's view?
For the most part, the Democratic Party at this moment is very united. You are seeing broad bipartisan support when it comes to aid for Israel. There have been fractures, of course, in the past regarding support for Israel, especially amongst members of the far-left progressive wing of the party. I'm thinking of individuals part of the squad. Many have come out and condemned what had happened over the weekend, but many also noted about some of the really devastating living conditions that Palestinians have had over the course of years and decades, and also poking holes at the current far right-wing tenure of the Israeli government.
AMH, thank you. The latest down in Washington, Anne-Marie Hordern. Let's continue this conversation with Nimrod Goren, the Senior Fellow for Israeli Affairs at the Middle East Institute, a non-profit institute that seeks to increase knowledge of the Middle East among citizens of the United States. Nimrod, thank you for joining us today. I want to pick up on a story that you've been discussing with us already, the relationship between Israel and Saudi Arabia. It looked like we were getting closer and closer to some kind of pact. There was a sense on Monday that the massacre that took place over the weekend would set us back. Do you share that?
It sets us back on the short term, but the process that we've seen over the last few weeks and months, in which there is a gradual upstepping of the Saudis of their engagement towards Israel, their openness to host Israelis first as business people, then as athletes, then as formal delegation with ministers in Saudi Arabia. There is an interest in the Saudis' sphere to engage with Israel, to go towards normalizations. There were discussions about the conditions. What happens now in Gaza will probably slow down the process, but once the dust settles, the interest is still there, and I guess the process will continue. It may take more time, though, than initially planned.
Nimrod, you've studied the peace processes that have been attempted in the Middle East for so many years. A lot of people are saying this feels different and more intractable than what we have experienced in the past. Can you put it into perspective in terms of how you see it potentially evolving based on the signaling that we've heard from people in the region?
What we say happening now in Gaza and in Israel is detached from the peace process, because the peace process was conducted with the Palestinian Authority, the leadership, the PLO, which has recognized Israel in the Oslo Accords, which is ready for a two-state solution. Hamas leadership is somewhere else. It has a position that does not recognize Israel. It is not supporting the two-state solution. As we see in current events, it engages in terror and in wishes to inflict as much damage on Jews and Israelis as possible. So this is not a partner of Israel for peace negotiations. I think the goal of such a process that we are seeing now on the ground will be to eventually have the Palestinian Authority, which is the more moderate faction within the Palestinian society, also rule the Gaza Strip, as was initially happening. And then you will have a leadership that has the capacity to negotiate, to try and advance the peace process. Of course, once we have in Israel a leadership that supports the two-state solution, currently we do not have that in Jerusalem as well.
Well, that's where I was going to go. There are a lot of questions about what the Israeli government knew before the attack took place, intelligence from Egypt in particular. What do you think the legacy of Netanyahu is going to be, and what do you think the trajectory of this will be at a time where people are coalescing around an emergency government now, but this has been a point of significant contention?
If there is an emergency government, it needs to focus on managing the war and not beyond. Netanyahu has failed. He's failed on our democratic identity over the last year. Now he's failing on our security. I think after this war is over, those in government should pay the price for their failure. And Israel is in need for a fresh leadership. It may take time. We know the tendency of the Israeli electorate are tilting towards the right in the previous elections. But we did see a government in the previous term of Yair Lapid and Naftali Bennett, two different ideological stances coming together for the national good. I think that's what Israelis want at the moment, something that is focused on national interest, on good governance, on moderation, and after the heavy price paid now, eventually when the discussion will turn back to politics from security, there will be a growing demand for change.
Nimrod, just to leave it there, do you believe that the division domestically led to those security failures?
It shouldn't have led to the intelligence failure. That's something totally different. But it did lead to a government putting its priorities in not the right positions or not the right places in terms of where forces were allocated, in terms of where the resources were invested over the last year. So this is not the reason. What happened Saturday shouldn't have happened anyway, with or without the divisions. There was something happening wrong, and that should be figured out and fixed. But definitely the context, the overall context of division, polarization, misconduct, didn't bring Israeli society to confront this challenge in the best possible terms it could.
Nimrod, thank you, sir, for your perspective. Nimrod Gurenner of the Middle East Institute. If you are just joining us, welcome to the program. Here's your S&P 500. We are positive here by 0.3%. Just to get you set up for the next 20 minutes or so, economic data in about 20 minutes' time, 8:30 Eastern time. We will get PPI data 24 hours before we hear from CPI. CPI data just around the corner as well. This is what we heard from Savita Subramaniam in the last couple of weeks. Equities can still work in a higher rate environment was a note that the team at Bank of America put out in the last week or so. Savita's going to join us next, Lisa.
Sebastian Page earlier just saying the same thing, and this is something people are coming to terms with. If those higher yields come, and this goes to a point you made earlier, John, if they're coming in tandem with strong economic growth, that can overwhelm the hit to borrowing costs. But that if is a big one, especially given some of the conversations we've been having, in particular with Talib Singh.
What did Tony Dwyer say over at Canaccord?
Yeah.
Got a lot of leverage in this system. Higher rates aren't good.
I know, and this is sort of the reason why people are flummoxed over why we haven't seen more of a reaction in the real economy to rates where they are. Deutsche Bank, George Saravelos came out this morning with a note that said that in the U.S., the reaction function that the Fed policy has been incredibly dampened in a way that has been completely unpredictable.
I'm going to use Kashkari's word, perplexed.
Keep using it.
Perplexed.
We're all perplexed all the time.
Savita Subramaniam of Bank of America coming up on this program in about 5 minutes' time. Later on, after that PPI report, the PPI data, we'll hear from Torsten Slog of Apollo. All of that coming up over the next 30 minutes or so. Your equity market on the S&P 500 looks like this. Equities up by 0.3% on the S&P. Yields are lower. That move fades just a touch. We're down 7 basis points from New York. Good morning. good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
So you're not selling the Patriots, you're not selling the packaging company. I guess you don't like to sell things, right?
I really don't. We try to create a family environment in everything we're involved in. People want to be part of something that's bigger than themselves.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
If the markets, in the case recently, bond yields have tightened, meaning financial conditions have tightened, that's an indicator of financial conditions broadly have tightened, it's more expensive to get a loan, then, well, if that's tight, maybe the Fed doesn't need to do as much. That's why I said, depending on whether it unravels or whether the momentum in the economy changes, that could be equivalent to another rate hike.
I do love Fed speak. It's like, just imagine, I'm just saying, I'm not saying that means we're not going to hike anymore, but maybe it means we're not going to hike anymore.
Different parameters that we can potentially look at that might potentially form our views because we don't know what's going to happen.
I'm perplexed, but ultimately high yields might mean fewer rate hikes. And, and then if CPI comes in strong on Thursday, I never said we wouldn't hike anymore. I just said that, if yields are up, theoretically, we wouldn't have to do so much.
Are you looking for a job? Which one?
I don't think anyone wants me at regional Fed.
Which not regional, maybe Fed governor.
They don't pay you enough for the board of governors at the Federal Reserve, do they?
Is that what you're saying?
Not at all.
All right, duly
Mary
noted.
Daly, they pay you enough on the West Coast. San Francisco Fed money's good money.
All right.
You seen that?
So I think maybe you've got to move.
Mary Daly makes good money on the West Coast. I always find that odd that the regional Fed presidents can earn like a multiple of what the governors earn on the FOMC. It's bizarre.
I think a lot of the debate, though, you want to attract the best and the brightest. So either you do it with pay that is going to be higher, or you do it with jobs on the other end that give people the idea that maybe they're being compromised. Either way, it's a lose-lose when you have a situation where public pay is often the flashpin of a lot of
Well, they can go and do
animosity.
speeches. I don't feel sorry for them, and they sell those speeches for like $800,000 a pop.
But I'm just saying, then people criticize the speeches, but it's partly because they're not paid that much at the outset.
When I used to cover the ECB a long time ago, once compared and contrasted the regional governors, so let's take Italy, the national governors. Italy, the Bank of Italy governor would earn more than the ECB president. So Draghi technically took a pay cut. And if you look at the S&B, Swiss National Bank.
That's where it's at?
Oh, that's where it's at.
Yeah,
I think it was something like 800,000 Swiss, something like that. Yeah,
Seriously?
check it out. Check it out.
Thank
you.
you.
Google
Are you
that.
trying to get me to go
I
fly
don't think you want to go
elsewhere?
to Switzerland. Well, that's good fun. Savita Subramanian, head of US Equity
Save us.
Quantitative Strategy, has a job at Bank of America. He joins us now. Savita, good to see you.
Nice to see you.
Good to see you. Constructive, and I read your note from the other week that this can work. We can see equity returns in a higher rate environment. So do lower rates hurt us or help us as well? Which one is it?
So I think that lower rates are, I think there's too much focus on the short end of the curve. I think the long end of the curve probably matters more for stocks. And then when I think about, why the long end is moving higher, one of the reasons is supply, demand. There's less demand from the Fed and China, BOJ, et cetera. But there's also this growth story that you could argue for, which is the idea that companies are now focused on, what they should be focused on. So we're in an environment where I think a lot of the levers for margin improvement from kind of lower quality sources like globalization or cheap financing are behind us, but ahead of us is this very exciting new theme, which we haven't talked about for a long time, which is efficiency, productivity, replacing labor with more efficient procedures, be it AI or automation, et cetera. So I think that those are the drivers that could move the market higher from here. Now, what's interesting is that so far this whole AI theme has only been rewarding tech. And I think that the story is so much broader than that. So, based on our quant work, we've found that if the S&P 500 has the opportunity to become even labor lighter than it is today, that translates into stable margins and a bump up in the multiple, because investors are willing to pay more for efficiency gains than just low quality, Fed money plus a little bit of globalization.
Are you saying that the AI boom has maybe been priced in accurately for tech companies, but inaccurately priced for the rest of the complex that will benefit in just as significant a way?
That is a much more eloquent way of saying what I just said with many less words. But I do think that that's the idea is we're in this environment where it's like old economy is terrible. Don't buy anything that's not tech. We're going to get money from this AI theme. I think the idea here is that old economy companies that are labor intensive have more tools to get labor light. And what we found in our quantitative work is that companies that become labor light always outperform companies that don't. And it's kind of an obvious point, but it plays out in the data.
Part of being able to get there and to survive long enough to get there is to be able to make investments, which requires money that potentially you have to borrow. So it raises a fundamental question about at what point the rate structure makes this prohibitive for some of these old economy companies to come up to the new world. What's the tipping point for yields where it starts to matter really significantly to you?
For the S&P 500, I think we can see higher yields. And I guess the good news is a lot of these problematic companies with floating rate risk and that are unable to handle current rates or higher rates have dropped out of the S&P 500. So there's been this sort of natural attrition out of the S&P into the Russell 2000. What I think is really interesting is that twice as many companies have fallen from the S&P to the Russell than have risen from the Russell to the S&P compared to an average year. So that is telling us that it's basically a story of the losers dropping out of the index into other indices. I don't love the Russell 2000 right now. I think it's riddled with small cap zombie companies like healthcare tech, companies that can't handle this rates environment. But I think the S&P 500 has seen a lot of those problem stories drop out, and it looks pretty healthy today.
You like the equal weight, right?
I love the equal weighted S&P 500.
Why is
Well, I just think that as you pointed out, probably a lot of this good news has been priced into the mega cap tech cohort, maybe even overpriced into the mega cap tech cohort. Everybody owns these companies, so there's not a lot of buying pressure if you think about who's next to load up on the Magnificent Seven. But there is a broader array of companies that actually look pretty healthy. And if we don't go into this, hotly forecast recession that we're all preparing for and bracing ourselves for, I think that the market could rip from here. The equal weighted S&P could rip.
It could rip. What kind of upside is rip?
So, it's all relative, right? I think that what we're forecasting through year end is 4,600 for the S&P. I think the equal weighted S&P could do double those gains. So from here, it's not that demonstrable.
Wow.
But I think over the next 10 years, buying the equal-weighted S&P 500 today on a valuation basis suggests that you could get more than 10% price returns per year from the equal-weighted S&P. This is not an environment where a lot of other asset classes promise 10% returns plus additional dividend yields.
What I'm doing technically, though, is stripping out the muscle of big tech.
Yeah.
And relatively speaking, giving, say, financials a bigger presence. Do I want to do that right now?
So financials is a tricky one. I like financials. I like large cap financials because A, the banks have already been regulated. B, a lot of the bad news is behind us. C, there's got to be a shape of the yield curve that helps the banks. And what's interesting is that every phase of the yield curve has been cast as bad for banks. I think we're actually moving into an environment where, if the Fed is closer to being done on the short end and the long end is potentially higher for longer, that's historically been a good environment for lending. I think the banks also have the opportunity, and old financial companies have the opportunity to get less labor intensive, which is bad for me, but it's good for margins of financial companies. So lots of levers that I think are underappreciated, as well as the fact that if regulated banks are regulated utilities now, why don't they have the multiple of a regulated utilities company?
Is your view predicated on the idea that we're really not going to get much of a recession? Is this basically predicated on the Fed's view of the world?
This is predicated on the idea that the reason it's taking longer for the Fed to control this economy is that a lot of that leverage risk has been taken out of consumers and corporates and moved to the public sector, the government balance sheet, and the Fed's own asset base. And while that all sounds nerve-wracking and terrifying, that we're sitting on, levels of debt to GDP that are similar to emerging economies, what we found is that high levels of government leverage are not anathema for stocks. So this is interesting because I've always been kind of worried, in the background, about this looming debt to GDP for the U.S. and what's it going to do to us. It seems really awful. Leverage is evil. The truth is the market actually outperforms or does better during periods of a higher leverage ratio in the public sector than lower. So leverage in the public sector isn't necessarily what we need to worry about. Maybe it makes our bonds that much less attractive, which, I think U.S. Treasuries might be the riskiest asset class.
We can have this conversation for a long time. I wonder if that's associated with coming out of bottoms in the economy, and that's where that deficit is widest.
And we grow our way out. Exactly.
Sure. Just got a headline from Norwegian Cruise, cancelling calls to Israel for the rest of 2023. UBS earlier banning work travel for the Middle East staff. Just the latest there. Savita, thank you. It's good to see you, as always. Savita Subramaniam there of Bank of America. Live from New York, PPI up next.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. The top names in global leadership are on Bloomberg.
Right from the start, I decided to open our border and to take in millions of refugees from Ukraine. We believed, and we still believe, that it is necessary, and we try to serve as neighbors should do.
If we want peace, if we want a negotiated outcome, strengthen Ukraine on the battlefield, because that's the only way to convince Putin that he will not win on the battlefield.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Here Here comes the data just moments away from PPI factory gate data that comes out heading off what we can see as a 1-2 bonanza. Today, PPI, tomorrow, CPI to get a read on inflation. Heading into that, we are seeing a bit of strength in the equity market, driven by a bit of strength in the bond market. Yields lower for a second straight day, although coming off some of the earlier lows, down as much as 10 basis points earlier this morning. But the two-day decline is almost 0.25%. Right now, we are getting that data. Let's head over to Bloomberg's Michael McKee. Mike.
Well, all the Fed people who've been optimistic may be a little bit disappointed by the numbers that we get today. A 0.5% increase in PPI for final demand on a month-over-month basis. It's down from 0.7 in August. However, that is almost double what was anticipated. The core rate comes in up 0.3, which is 0.1 more than it was the prior month. And the super core for PPI, ex-food, energy, and trade services is up 0.2. That's a slight improvement. For final demand on the year-over-year basis, we're up 2.2%, which is unfortunate. We were 1.6% in August, so going the wrong way and back over 2%. Ex-food and energy, 2.7%. That's up 0.5 percentage point from the August number. And the ex-food, energy, and trade number comes in 2.8%. That is down from 0.3. So where we're seeing some improvement is in the retail and wholesale sales side, the trade figures, but the rest of the PPIs rather coming in a little hot.
Right now, just taking a look at the market response. It's not massive, not a lot of drama, but you are seeing a bit of a give back to some of the gains in the bond market. Yields rising just a touch, as you would expect, hotter than expected PPI data. You're seeing in the stock market, again, a little bit of the reversal of some of those gains, but not a lot of action, which actually is exactly where I want to go with you, Mike. Are you surprised that there's not that big of a reaction, or is this pretty much typical because it wasn't that big of an upside surprise and because PPI isn't as significant as CPI?
I think that last line there, Lisa, that you just said is the most important thing in terms of the market, because the PPI doesn't necessarily lead the CPI in the way people might think, and the CPI is what everybody's been focused on. The interesting thing in this number is that we saw goods prices up 0.9, while services prices were only up 0.3. That's the second month in a row we've seen a big increase in goods prices. I don't know exactly what's pushing that up, but it is the opposite of the trend we had been seeing over the past 6 months or so. I think tomorrow everybody's going to be focused on the CPI, and if we get a different kind of result there, then markets might react a little bit more strongly.
There's also a question about how much companies can pass along some of these costs to consumers, and for a while with the disinflation, that was leading to bigger margins because companies were still passing along price increases to people, and they were absorbing them. Do we have a sense of whether these price increases that we're actually seeing actually reaccelerate, that is going to lead to higher prices in the CPI, or that companies are just going to absorb it, and that means margins coming down?
Well, we don't know exactly, but you can separate out the trade services component of PPI, which is basically retail and wholesale margins. The government doesn't have a good way of measuring prices in those areas, so they look at the difference in margins for companies, and that goes into this PPI calculation. So that area did show a decline, so maybe companies aren't being able to pass on price increases quite as easily. Anecdotally, that's what you hear. That's what the Beige Book says. That's what Fed officials say CEOs are telling them. We're getting a little bit of evidence in this PPI here, but it'll be the CPI and then PCE at the end of the month that'll be determinative for the Fed.
Michael McKee of Bloomberg, stay close, please. I imagine you'll be looking through the data more closely and some of the details. And we'll catch up with you in just a few minutes. Just if you're just tuning in, we did get that economic data coming in hotter than expected. Ex-food and energy, you saw a 0.3% pop versus the expectation for 0.2%. Final demand, 0.5% versus 0.3%. Bonds just retracing a little bit of their gains. You can see yields down now just 6 basis points, down as much as 10 basis points earlier in the morning, 458.91, and you can see S&P futures now up by just 0.2%. Someone who's been tracking the sort of push-pull between inflation and potential weakness around the edges is Torsten Slok, chief economist at Apollo Global Management, who puts out charts that we cite pretty much every single day. And Torsten, I just want to thank you and your team because we always use them as talking points and hot topics, so we appreciate that. But I want to start with your impression of a reacceleration that we're starting to see on the margins in goods prices.
I think what's most important really here is it shows how difficult it is to get the horse back in the barn when it comes to inflation. You think about first, goods inflation went up when we were sitting at home ordering stuff online during the pandemic. Then goods inflation came down when the supply chains came back on steam. And now, as Mike was just pointing out, it looks like goods inflation is beginning to reaccelerate because manufacturing is beginning to show more signs of life. And you have, broadly speaking, therefore, a separate cycle in goods inflation relative to the cycle in services inflation, where initially, when we were sitting at home, there was no service inflation. Now we're all going to restaurants, hotels, basically flying consumer services, and that's why service inflation has been very high. So that cycle difference has been a very important feature, and it shows in the data also today.
What we did see, though, during the immediate aftermath of the pandemic was that people weren't as sensitive to price increases because they accepted that inflation was happening and they had huge bundles of savings that were left over from the pandemic. Is now different? Are you seeing consumers push back, spend less, not actually spend when they see prices going up that much?
Well, if you look at what was the distribution of consumption on goods and services before the pandemic, we have not normalized back to that level in terms of the shares spent on services relative to the shares spent on goods. We still spend, quote unquote, too much on goods. So that means that services still has some more upside. So you're right, people have been willing to spend more money to go to Taylor Swift tickets, US Open in Queens, all these things that have been so expensive because there have still been savings around. But as we all know, and as we talk about all the time, we of course have this issue that savings are running out, combined with student loan payments coming back. All that does point to still more weakness on the consumer in the coming quarters.
When you put charts out, especially on that savings rate, how much pushback do you get from people? Because everyone is so discerning of the type of data and the way that it's being framed, that a story painted with data can be dissected in 5 different ways by 5 different people.
That's right, and I think that's also why it's not only about savings running out, it's also about the very big picture that the Fed is trying still to cool the economy down. We hear that also from Mary Daly here in the segment you just played, where we're seeing already in the data, consumers are seeing higher delinquency rates on credit cards and auto loans. Corporates are seeing default rates go up on high yield and on loans. We're also seeing interest coverage ratios starting to dip, both for investment grade and high yield. And also on the banking side, we're also seeing a slowing in loan growth. In the weekly data from the Fed, both for large banks and for small banks, so taking consumers, corporates, and banks combined, the Fed is succeeding. This is exactly what the textbook would have predicted, that we're seeing a slowdown on consumption, on corporates, and on banks, and that's why this ultimately will result in more slowing over the coming quarters.
More slowing and recession. More slowing is not the same, right? And there's a question of how much slowing is necessary to truly put the horse back in the barn, as you say, to use your analogy. And this has been one of the conundrums that's been baked into the market. Do you have a sense of whether it requires a greater slowing to get that horse back in the barn than people are currently using as a base case? And when I say people, I mean Fed officials.
I do think that we need more slowing because core PCE today is 3.9, and the target for the Fed is that it should be 2. So we are still running around after the horse out there and trying to get it back into the 2% range, and we're just not there yet. That's what literally every FOMC member is telling us. So with that backdrop, given what's happening to delinquency rates for consumers, given default rates for high yield are going up at the fastest rate in the last 6 months in years. So the result of that is that we are seeing the effects of the Fed tightening. Every single day, there are companies that cannot get financing. There are consumers who cannot buy a new car, and at the moment, who have a hard time buying a new home. So in that sense, tighter policy with the Fed funds rate at 5.5 is way, way above the 2.5% where the Fed in the dot plot thinks we should be in the long run. So policy is working exactly as the textbook would have predicted. It's just the savings making it take a little bit longer time, but we are moving towards, in my view, a faster slowdown, what the market consensus is expecting.
We're going to put the horse back in the pasture and leave that alone for the remainder of our time, but I do want to know why we are seeing upside surprises to the economic data in such a significant way. If there is this material slowing. I mean, this has been one of the conundrums for so many people who are expecting and seeing anecdotally all of the slowing, and yet each economic print coming in stronger, stronger, stronger.
There are some exceptions to that. I know the labor market obviously is surprised to the upside on the headline, but if you look under the hood, you see that, particularly in terms of job openings, peaked literally in March of 2022 when the Fed started raising rates. That's been coming down. You're also seeing the work week coming down. You're also seeing wages for job switchers coming down. You've also seen an increase in percentage of permanent job losses. So a number of the labor market indicators under the hood are showing more signs of weakness, and we are definitely moving towards that we will ultimately get that increase in the unemployment rate that Jay Powell has talked about.
Given the unrest in the Middle East, there's a lot of focus on oil prices and what would happen if oil prices do have a sustained rise. How do you factor that in to your concept of a harder landing than people are certainly accepting?
That is certainly a very important point. I mean, oil prices, now they first went up and now they've gone down a bit, but it's certainly the case that the move in oil prices is very critical also, in particular, of course, for headline inflation. So from that perspective, the second round effects are likely going to be more limited. At least historically, they have become more and more limited over time because the economy is less sensitive to oil prices, is less energy intensive. But the short answer to your question is for headline inflation, and therefore also for the Fed, it does become important what oil prices are doing.
When we shake out, where are you? Where is your thinking in terms of the long-term neutral rate and how much it shifted upward, given some of the paradigm shifts?
I think that there are some very important arguments for why the long-run rate is going to be higher. We first of all have more deglobalization, more segmentation globally. That's putting more upward pressure because of onshoring or reshoring and friendshoring, increasing cost of production. We also, generally speaking, have that energy transition is going to be costly. That also is going to put upward pressure on the production of energy, and therefore if people pay more for energy, including the adjustment cost, then that will also be putting upward pressure on inflation. And finally, we likely also have globally less immigration, and if that's the case, that also means that we're likely going to see higher cost of production, not only in the US, but also in Europe and abroad. So the conclusion is both deglobalization and also energy transition and also what might be happening with immigration all argues for that the long run rate, neutral rate, is likely going to be high. The Fed says that in the long run will be 2.5, but we could be up closer to 3, maybe even 3.5. And that's very important for anyone planning with a long horizon, because that's telling you that on page 1 in the finance textbook, if the risk-free rate is going up, we all in financial markets need to pay attention.
Torsten Slok of Apollo, always wonderful to get your thoughts. Thank you so much for being here with us, Torsten Slok of Apollo. I just want to update you on the figures. We did get PPI final demand coming in 0.5% versus the increase of 0.3% as expected in markets. You can see what you would expect, although muted, because the relevance of PPI to final prices, not necessarily that correlated, but still, the 10-year yields lower now just by about 7 basis points versus 10 basis points earlier. S&P futures up by 0.2%. Right now, I do want to head back to Michael McKee, who is in our Bloomberg Washington, D.C. bureau. And what are you finding from the data as you parse through?
Well, this is interesting, Lisa. In the overall PPI for final demand, goods prices, as we mentioned, rose 0.9%. The BLS says 3/4 of that was energy, a 5.5% rise in gasoline. Now, this is at the wholesale level. When you look at this at the retail level, we did not see a major rise in gasoline prices. So the CPI may tell us a different story tomorrow, may not be picking up energy. When you subtract energy and food out of the PPI, you end up with just a 0.1% rise in the goods category. So it really was an energy story there. On the services side, services only rose 0.3%. But a lot of that was, again, banking and deposit services, a 13% increase. And that is something we've seen in the CPI as well, where where banks and brokerages are making more money on commissions, and that is coming in as an increase in inflation. Not something that the Fed is going to particularly worry about.
So just putting this together, Mike, not a lot of correlation for tomorrow, but expectations for tomorrow are for a similar cooling, correct?
That's correct. They are thinking we're going to just see a small increase of 0.3% in the headline again, and that's not going to push up the year-over-year number too much.
Michael McKee, as always, thank you so much. Coming up, Bloomberg's Alex Steele on the Exxon Pioneer deal as we parse through what the potentially biggest deal announced globally means for the Shell, the Permian Basin, as well as oil globally. This is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
What we know is that financial market conditions have certainly tightened. That's not even a question. I think the important thing to note there is that allows us a little bit of patience, that we can continue to watch as economic conditions and financial conditions continue to evolve.
That was Mickey Bowman, Federal Reserve Governor Michelle Bowman, speaking at a panel in Marrakesh at the World Economic Forum, at the IMF and World Bank meetings that are taking place there. Our own colleague, of course, Tom Keene, is heading that way, and we will be catching up with him soon. This morning, we've been talking about a whole host of issues, of course, the conflict in Israel, as well as the economic data that just came out in terms of inflation and how much it's coming in, maybe not as fast as people would like. You can see that playing out in the markets, although not really that significant move given the fact that we got an upside surprise to inflation. Right now, we are seeing the S&P up by now just 0.2%, and bond yields lower by less than they were lower earlier in the morning. Big discussion point around oil, not only the price and where it's headed due to some of the unrest in the Middle East, but also Exxon, close to a $58 billion deal to buy Pioneer Natural Resources, which would be the biggest deal that Exxon has done since 1999, the biggest global deal of the year, making them absolutely the dominant player in the shale patch. We're seeing now Pioneer shares up 1.7%, 241, quite a bit of ways from the $250 a share price tag that would be in this deal. You are seeing Exxon shares off just a touch. Joining us now, I'm so pleased to say, to give us a lot more light than I certainly could shed, Bloomberg's Alex Steele and Julian Lee joining us. Alex, I want to start with you. Why is this deal so important?
So first of all, $59.5 billion is nothing to sneeze at, an 18% premium for Pioneer. This is an enormous deal, and the broader context is that this could potentially unlock shale, what people are calling shale 3.0, which would be a huge wave of M&A, big deals, big spending in the Permian, and really long laterals, which is basically the technique that you use to get a lot of oil out of shale. And that would be a very different place than we were in just a few years ago, where it was very much reducing capital spend. Interestingly enough, many analysts say that buying Pioneer is being CapEx sensitive, because it actually longer term will cost less than having to increase CapEx to keep production even level, much less growing, funnily enough.
There's a question about whether part of the reason why now this deal is happening is because regulators will be more okay with it, that actually this is going to be more amenable to both investors and to regulators because of this emphasis on energy independence and this idea of just generally focusing a bit more on the need for fossil fuels rather than the move away?
Yeah, you know, I see it twofold. I think, one, it is going to have some antitrust issues. I think this gives a lot of fodder to the Greens in D.C. to say you're spending $60 billion on fossil fuels. You're spending, you know, $17 billion in the next few years on carbon solutions and low carbon solutions. So there's that part. But in terms of kind of why now, I wonder, and I'll ask the CEOs this in the next hour, is this actually a Scott Sheffield thing? So Pioneer Natural Resources is like the holy grail of the Permian. Scott retired once, then he came back because they didn't like the CEO at the time, and he's retiring at the end of the year. There's also been some productivity questions for Pioneer over the last 2 quarters. It just basically means you've gotten all the good stuff out of the rock. There's more there, but the really juicy stuff has been drilled. And can you really get more out? Many say that that problem has been solved, but still, a productivity question. There was underperformance over the last few months of Pioneer versus its peers, and I wonder, and I'll ask it, if that played more of a role.
I'm wondering, Julian, from your standpoint, where the U.S. plays in the global oil sphere and how much deals like this and just generally looking for more efficiency and, frankly, record production this year plays on the global stage at a time where Saudi Arabia is trying to control supply that much more.
Yeah, I mean, you know, the U.S. is certainly playing an important role, and growth in output in the Permian and other shale basins is going to be important. I don't think this deal sort of changes the outlook for oil prices in the short term, but potentially over the longer term, it may do. It certainly, I think, brings together contiguous acreage, you know, acreage next to each other under a single owner. That allows for longer horizontal wells to be drilled, greater economies of scale in terms of that investment in new drilling. That could boost the prospects for Permian production and U.S. production in total, but that's probably 2 or 3 years away at least. In the short term, I think it doesn't change anything, but what it does do is mean that the shale basins of the U.S. are going to be important contributors, not just to production, but to potential production growth in the 4 to 5 years ahead.
Julian, from your vantage point, how much are deals like this made possible based on oil prices being higher, and if you have the feeling that they are going to remain so in the longer term?
Well, I think, you know, there are many things, I think, that have factored into this deal and why now. And I think, as Alex said, the Scott Sheffield question is certainly potentially one of those. As to oil prices, I mean, at the moment, they are very much being dictated, I think, by Saudi Arabia's oil policy. They want oil prices somewhere closer to $100 a barrel than 70, for example, and they are prepared to make the production sacrifices at the moment to ensure that happens. The big question is going to be over the longer term whether they can continue to do that if demand growth starts to ease off, as people are expecting next year, and we get additional supplies coming on from places like the US, Guyana, Brazil, and so that's going to be a challenge for Saudi Arabia perhaps over the next 12 to 24 months. The immediate question is how this terrible attack by Hamas on Israel is going to play out. We saw a jump in prices followed over the last couple of days by something of a retreat. Very much is going to depend on whether this conflict spreads and starts to suck in oil producers in the Middle East, Iran being the big question mark.
Alex, your idea, just in terms of the pricing and how that factors in.
Yeah, so one analyst said that Pioneer has 6,300 net locations of high-quality inventory. That's like top-tier acreage where you get a 10% return at WTI prices 50 or lower. So, like, the last barrel produced may increase, like you might need $80 a barrel for that kind of floor, but you're buying stuff that you can make money and have a nice return sub 50.
Which is the reason why I think people are doing this. Alex, what are you hearing in terms of other deals coming down the pike to either compete with this or just that have been in the works and suddenly people are finding the reason to get it done?
So it's going to have to happen, because if you're a mid-tier player, you will not be able to compete with this. So the Oxys of the world, you have Chevron, like they're going to be just fine, even though they're dwarfed a bit by this deal. But the smaller guy, I don't know how you're going to do it. And there's a lot of small mom and pop private companies as well that have already been kind of pulling back on some of their drilling, and the theory is they're doing that so then they can clean themselves up a little bit to then be bought. So we'll see how quickly it takes for that to happen.
And just real quick here, Julian, not to pivot too much, but I would like to get a final word from you on what you're hearing out of Iran and how much further crackdown of sanctions would really influence the price.
Well, I mean, we're hearing relatively little out of Iran. I mean, there's been, political support voiced for Hamas, as there very often or generally is from Tehran. We're not hearing anything yet about action against Iran or any action to try to restrict their oil exports. We've seen a fairly substantial increase in estimates of production and exports over recent months. That's been an important factor in holding oil prices lower than they would otherwise have been. And there is a challenge here that if you start going after Iran's oil exports, that is going to have an impact on the oil price.
Yeah.
And nobody wants higher oil prices in the consuming countries.
Julian Lee, Bloomberg's Alex Steele, thank you so much for being with us. And tune in to Bloomberg Television today at 9:40 a.m. for Alex's interview with Exxon CEO Darren Woods and Pioneer CEO Scott Sheffield to answer some of those questions. Also coming up on Bloomberg Television at 2:45 p.m., Professor Ken Rogoff of Harvard University is speaking at a time of a lot of uncertainty in the economy. We did just get that hotter than expected PPI print. Leading into tomorrow, we will get CPI. We are seeing a bit of a response in markets, but no drama. We are still seeing the S&P futures up 0.3%. We are still seeing bond yields lower, now by almost 0.8%, reversing the earlier bit of a pop. This is Bloomberg.
Next week on AI IRL.
I do think it has a tremendously positive effect on democratizing technology. I mean, just imagine what it must feel like if you are a country in Latin America, Sub-Saharan Africa, or in other parts of the world where you just don't have either the money, because you need a considerable amount of money, or the very significant GPU computing capacity, or the data to build any of all of these things.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
That's me, Max. What's up? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
New York City this morning. Good morning, good morning. Three-day winning streak on the S&P 500. New York City this morning. Good morning, good morning. Three-day winning streak on the S&P 500. Longest winning streak going back to late August. Can we add to it? The S&P up a third of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the Israel-Hamas war entering day 5. Hawks at the Federal Reserve looking lonely as Exxon closes in on its biggest deal since 1999. We begin with the big issue. Is it different this time?
It's a timing thing.
The whole idea that the recession is 1 to 2 quarters away, it's now going on 18 months.
You're just not seeing the slowing that many market participants thought that you would see.
The payroll number from last week and some of the recent data,
the bottoming and the PMI data, et cetera.
It's hard to make the case that we're seeing some kind of a real recessionary slowing in the economy.
It doesn't seem like things are breaking yet.
I guess if you say it long enough, eventually those 1 to 2 quarters away will eventually materialize.
The stronger economic data really means that the U.S. Federal Reserve is probably going to be the last hawkish central bank standing.
Financial conditions have tightened.
There's even more tightening being put into the system.
We've seen early signs of credit card data that have really fallen off.
A lot of challenges coming up for the U.S. consumer.
The ugliness under the hood can come out pretty quickly.
Things could be okay for a little while longer.
Joining us now to discuss is JP Morgan's Priya Misra, Larry Adam of Raymond James. Priya, to that point, could things be okay for a little while longer?
I think for a little while, possibly, but I would argue that the lags are actually much longer this time. So the reason that the economy's been okay is if the consumer has essentially locked in a mortgage rate, if equities have been okay, I think the wealth effect has essentially helped, and the fact that the labor market is still strong. But at some point, we've had a very dangerous increase in interest rates, I would argue. Over the last month or so, it's been led by the long end, it's been led by real rates, it's tightening financial conditions. Are we talking the next couple of months? Perhaps, but I would say that we are seeing the slowing in consumer spending. Does it slow down to recession levels? I think it's too early to say. I would argue that the tightening in financial conditions, the fact that the labor market is slowing, notwithstanding Friday's number, but you are seeing some signs of slowing, plus the tightening in financial conditions is likely to slow us into a hard landing. We're in the hard landing camp. You just have to be patient because this could be 3 to 6 months out.
The whole year has felt like a 3-month rolling recession call, Larry Adam. We keep hearing the same things. You've had a long-standing call, Q1 24, it's coming. Is it coming?
We still think that it is coming in the first quarter of next year. And the reason for that is, first of all, we thought that the third quarter would be fine, right? Everybody was out there traveling. We called it the summer of travel revenge too. So that was expected. But now as we go forward, what you're seeing is that a lot of the savings now that everybody had, excess savings, that's evaporated. And I think now that interest rates are getting higher, that's making it much more restrictive for consumers to gain access to credit. We do a survey, John, every quarter. And in this most recent survey, only 5% of the respondents said they're going to spend more over the next 6 months than they did over the previous 6 months. 33% said they're going to spend less. Just keep in mind that if everybody spends the same, that's a recession when you take into account inflation. So I do think we're headed for inflation, although I have to say that it will be mild.
I'll give you another survey. New York Fed survey of consumer expectations. A larger percentage of consumers, 12.51% versus 11.11% in the previous month. expect to not be able to make minimum debt payments over the next 3 months. Priya, is that why you look at this as a hard landing or no landing, that ultimately when it bites, it's going to bite hard?
Exactly. Yes, I think debt levels have been rising. Now, if I have a job, I still had my COVID savings, I can essentially pay that higher interest rates. But as consumers take on more and more debt, and these tend to be floating rate debt payments, you know, that interest rate starts to bite. I would say it's going to bite corporates as well. We're going to, you know, the earnings season is starting. How much do companies start talking about high interest rates impacting them? So, yeah, I do think it's going to come down to those COVID savings actually running off. I think it's important to look at the distributional aspect. I think lower income households have already run through these savings. So, you know, as consumer spending, and I think we've all often looked at initial claims, we've looked at the labor market. I actually think that's going to be a lagging indicator of the economy. It's consumer spending. It's that credit card, you know, spending that we're watching, and we're seeing some worrying signs already on that front.
Well, apparently the champagne drinking is coming to an end. LVMH out with some numbers yesterday. That stock over in Paris, France, trading lower by more than 5%. Earlier on today, wiping out the gains for the whole of this year. At one point, that name, LVMH, was up close to 30% year to date. That was back in spring. It's faded and faded fast. The CFO of LVMH said this. Larry, I'd love your response to this. After 3 roaring years, outstanding years, growth is converging towards numbers that are more in line with the historical average. Raises the question, Larry, what are we going back to?
So I think that means you're going back to the frugal consumer, where every penny matters when it comes to spending. When it comes from a corporate perspective, I think those long-standing big increases that we've been seeing by businesses, I think they're likely gone. And then I think from an economic perspective, I think that means growth here in the U.S. is probably along that more trend like 1.5% to 2% than what we have been seeing, you know, north of 2-3% that's been coming in. So I think that's what it means to a return to normalization. The one point I wanted to make about recessions, though, is that everybody thinks that the economy is too strong, right? That Atlanta Fed GDP number coming out at 5.1% for the third quarter. But keep in mind that the change in the economy can happen on a dime, right? We went back over the last 12 recessions. The quarter leading into the recession, growth was robust at about 2.6%. The first quarter of the recession, growth was negative 3.5%. That's a 6 percentage point turnaround in the economy. So it can happen very quickly.
Well, let's talk about the data we've had so far this morning. Upside surprise on PPI. Looking ahead to CPI tomorrow. Mike McKee's going to break this down for us over in Washington, D.C. Morning, Mike.
Good morning, John. Yes, an upside surprise to PPI. Whether it translates to CPI, a totally different question, but we did see stronger than expected PPI for final demand, up 0.5% after 0.7 the month before, and that pushes the year-over-year number to 2.2. Take out food, energy, and trade services, and you have a much more restrained 0.2 rise and a 2.8% rise in the year-over-year number, which is down from August. Now, you can see the CPI numbers there. They're not changing so far in terms of what went on. Basically, what we found out, and you can see this in the chart, next chart, PPI doesn't necessarily lead CPI at all. And in the PPI, most of what we saw pushing the prices up is energy. Gasoline was up 5.5%, but we didn't see that in the CPI. So the CPI may reverse this trend here and come down faster than PPI. What does it all mean for the Fed? Well, it's kind of funny. You were talking about how everybody's been down on the economy because we were going to see rates do the work for the Fed, and a lot of Fed officials have jumped on that bandwagon. Does this change with CPI or PPI? We'll have to see, but you can see we've brought out the sorting hat again, and there's a significant number, including 4 voters, who have come out and said in the last week that they think the Fed can be on hold. There's still some hawks out there. Tom Barkin remains undecided. But beyond that, what we're looking for is to see what the Jay Powell view is. That'll be coming up next week.
Mike McKee, looking forward to that. Mike, thanks for breaking things down and following all this Fed speak for us. Let's get back to the sorting hat and go through a couple of those names, in fact, 3 of them. So in the last few days, this started last week, we heard from Daly, we heard from Logan, we heard from Jefferson, and then Kashkari, all basically alluding to the idea, Priya, that the bond market could do some of the work for them. And as they do that, Priya, the bond market stops doing some of the work for them. What do you make of their recent comments?
So there's a bit of a circularity here, right? Essentially, if there's a big easing in financial conditions, I think the Fed will start talking hawkish again. But I think if we take a step back, what's going on here? I think the Fed has shifted the goalpost a little bit. I think they were all focused on inflation, I would say, 6 months ago. That shifted to growth. There's still a Phillips curve somewhere in the back of the Fed's mind. If growth is strong, it's going to be very hard to get inflation back down to target. And I think in the last couple of weeks, the focus of the Fed is shifting back to financial conditions. But, we've had a very meaningful rise in real rates. And I think the Fed is not saying that they're going to undo this. I think they are nervous that they might have gotten too much of that financial condition tightening in a short period of time. I think the bond vigilantes are back. Anybody who's been trying to fade the duration move has been hiding under the table because it hasn't worked. And, these moves extended to the point where the Fed probably got nervous. I do think the focus on financial conditions is going to remain. If the economy starts to slow down, I think then we'll be all looking at the Fed. When do they start to ease? And I think that's where they're going to be tough again. They're going to say inflation's not back to normal. And so I think that's going to keep it's going to keep financial conditions on the tighter end of the range. We've been used to a preemptive Fed. I don't think that's happening. The last mile on inflation is going to be the hardest. And so if the Fed is going to hold still, and I think they're trying to signal that they don't need to hike a lot more. But notice, even the doves are not saying that they need to ease anytime soon.
True.
I think they want to hold here until inflation gets back down. That's going to be a difficult time for financial conditions. So I see a little bit of easing given Fed rhetoric, but I don't see significant easing because we're not talking about the Fed cutting rates anytime soon.
Priya, before making calls about what's going to happen next, I think we need to understand what's happened over the previous 5 weeks with a massive move, yields higher. Priya, you've got a different reasoning for what's happened. You hear all these things about buyer strikes, supplies, etc., etc. What do you think it was?
So I would agree that it's been term premium led, but why? Why have term premiums suddenly woken up? We've had a deficit issue for a long time. I would argue it's the buyers stepped away. And why did the buyers step away? We heard from the Fed loud and clear. The bond market heard the Fed saying higher for longer, saying that, if you look at the dots from that September Fed meeting, they signaled a higher real rate, overnight real rate, even at the end of next year. Even though we're seeing the economy slow down, you have the Fed saying, well, we may have to be more restrictive next year. And so I think the bond market heard that. Anyone who was trying to buy duration here as a hedge has to question, is the bond market, are treasuries a good hedge if the Fed is going to be extremely restrictive? So I do think the Fed message drove rates this last 50, 80 basis points of rates, which is why I would think it's a very notable shift. If the Fed is suggesting, well, not so fast, we don't plan to be that aggressive, I think the bond market can actually take a step back and some of these oversold positions can start to be pared back.
Larry, do you agree?
Well, I think the move up is just it's been overreaching. It's overextended, right? I mean, I think the narrative in the market, like it normally does, it goes to extreme levels. And all of a sudden, you started hearing everybody saying that rates are going to continue to move higher. Some people on your show, right, talking about rates going up to 6-7%. I think the market got overextended to one way. When you look at the positioning, you had record shorts in the bond market. And I think that tends to be a sign of a top. And what you're seeing is that it doesn't take much of a catalyst to actually see the reverse take place. And that's what we've seen, whether it was the flight to quality because of what happened over in Israel or some of the rhetoric from the Fed. The move can move in the opposite direction. And fundamentally, we think that rates are moving lower from where they are today.
We've been whipsawed from one session to the next. Larry, Adam, Priya Misra sticking with us. Yields lower this morning. They were a whole lot lower a little bit earlier on this morning. The 10-year yield down about 7 basis points. Let's call it 458 on a US 10-year. Let's get you some movers going into the opening bell. Here's Abby.
Well, John, there's a bit of a bullish tone on that yield action with the S&P 500 E-mini future set for a fourth higher day, the longest winning streak in almost 6 weeks. And one stock helping out, Eli Lilly, rallying in sympathy with Novo Nordisk's diabetes drug in a trial that, of course, is also used for weight loss. But now it's being proven to be highly effective in treating kidney failure. So it is thought that Lilly's drug will be similar. Now, on the other hand, DaVita Healthcare on the bottom of the board plunging down 18.3%. That is a dialysis provider. So if this drug does prove helpful for kidney failure, it could eat into some of DaVita's business. And then Pioneer Natural, also another bright spot on the day, up 1.4%, of course, on the news that Exxon is buying the Permian Basin basin E&P producer for $59.5 billion. It's their biggest deal, as you mentioned earlier, since 1999. $253 per share. It's pretty close to that, suggesting investors think the deal will probably get done.
Abby, thank you. A conversation with the boss of Exxon, the boss of Pioneer, a little bit later this morning. This hour, 30 minutes away with Alex Steele. Do not miss that conversation on Bloomberg TV. Coming up, the Israel-Hamas war, entering day 5.
There's a very strong feeling that Israel has to go after Hamas for these unspeakable horrors that they've been engaged in. And they've got over 300,000 reservists that have been mobilized.
That conversation up next.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
City, in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Going into Gaza is not going to be easy. They've tried it before. The problem is that it's basically house-to-house fighting once you get into Gaza, and so it could be a heavy price. But on the other hand, I think it is very clear that Israel has made the decision that they have got to crush Hamas in Gaza.
Israel building up troops near the Gaza border, potentially preparing for a ground invasion. Hamas saying it's prepared to kill Israeli hostages if that happens. And Secretary Yellen saying the administration isn't ruling out more sanctions.
We have not in any way relaxed our sanctions on Iranian oil. And we have sanctions on Hamas, on Hezbollah. This is something we have been constantly looking at and using information that comes available to tighten sanctions.
Secretary Blinken is heading to Israel. President Biden is preparing to deliver remarks at 4:15 Eastern Time. Bloomberg's Anne-Marie can catch up with us right now. AMH, what's the latest?
Well, Jonathan, this afternoon we'll see the president join a roundtable of Jewish community leaders. He's going to talk about what he said yesterday, the unwavering support the United States stands and has with Israel. He's going to talk about the sheer evilness of this attack by Hamas, which the U.S. designates as a terrorist organization over the weekend. And he's also going to talk about fighting anti-Semitism. And he talked about this yesterday as well in that speech he gave from the White House, talking about how these images we're seeing bring up the millennia we've seen when it comes to anti-Semitism and genocide against Jewish people. These were the president's remarks yesterday. They were very forceful, they were very strong, and he was very direct in the U.S. standing with Israel. Now, Jonathan, of course, we also have his top diplomat, Secretary Antony Blinken. He'll be in Israel. He's going to be assessing the situation and seeing what the Israelis need on the ground. That comes as reports about the first shipments of fresh ammunition is hitting Israel. And, of course, when it comes to Iran's place in this, what we heard from the Treasury Secretary is she's basically not taking it off the table that there could be fresh sanctions against Tehran, given the fact that while the U.S. is being very careful not to draw a direct line between Tehran and Hamas in terms of this attack, Iran is complicit for years and decades of giving material support, whether that's cash, whether that's manufacturing and how to manufacture weapons, and training of Hamas individuals. Iran has had Hamas's support and back.
Anne-Marie, are we talking about new sanctions or enforcing existing sanctions?
Well, the Treasury Secretary said there that they have not stopped the enforcement of Iranian sanctions. This has to do with the exports of Iranian oil, which we have seen, given independent trackers, that have gone up. The IEA said in July that Iran is now producing 3 million barrels a day. The United States is a member of the IEA. So it's a little bit of a question, and it seems blurry when you ask officials when they say that the enforcement hasn't stopped, but we do know, given independent reports, that Iran is exporting more crude. So potentially the U.S. will start to look at making sure that enforcement of those sanctions that are already in place are up to scratch. And then the Treasury Secretary said she's not taking anything off the table, so that would be fresh sanctions.
Square that circle. AMH, thank you. The latest down in Washington from our chief Washington correspondent. Crude this morning, a little bit lower, down by 0.8%. WTI 85, Brent at 87. Priya Misra, Larry Adam back with us. Priya, this move in the bond market, one part risk aversion, two parts Fed speak. I'm sure a lot of people might agree with that assessment. The 10-year yield is down by about 5 or 6 basis points. Let's go through this together, Priya. On Friday, the cycle high on the 10-year, 488. On the 30-year, 5.05. Now we're at 460, and on the 30-year at 475. Are you confident enough to say that we saw the cycle highs on Friday? Were there the highs on Friday's session?
You know, it's always hard to actually call the exact top in rates. I think we're pretty close there. I mean, whether it's 488 or 5%, I think it's asymmetric in the sense that the bond market is pricing in a soft landing. I would say a combination of a soft landing and a no landing scenario is essentially priced in. We barely have any rate cuts priced in. So if you get a hard landing, I would argue that then rates have a lot more room to fall. If we actually do end up in this immaculate soft landing or no landing scenario, then rates probably have another 20, 30 basis points of increase. So I think it's asymmetric. The reason to own duration is that asymmetry. You get that yield, and then I think you get that diversification play. If we do see that soft landing, you know, I think risk assets are cheering somewhat right now because maybe this rate risk or the fact that the 10-year might go to 5%, 6%, I think that risk seems to be much lower. But we still have to deal with fundamentals. Is the economy strong enough, and are risk assets pricing in some chance of a hard landing? I would say 50% chance of a hard landing in the very near term. And so I think if risk assets struggle here, as the economy slows down, which is our base case, I think then treasuries actually give you that diversification advantage. So I think we're very close to the highs. I would say we've passed it, but, you know, give or take 25 basis points. And I think owning duration, particularly if you're in the front end of the curve, 0 to 5 year, you're not taking on that much risk going to the 10-year or the 30-year. I think it's an attractive point right now. It gives you liquidity, and it gives you that diversification as the economy slows down.
Larry, final word. Do you agree with that risk assessment?
I do. I think rates are going to go lower from here. As Misra said, it's hard to call the top, but given some of the volatility that we've seen, typically that is a sign of a top. I do think that rates will move lower because I do think we're going to see a mild recession. And if you look back at the last 5 recessions, the 10-year Treasury yield has fallen by about 120 basis points. That gets you closer to 3.5 to 3.75. When the Fed ends its tightening cycle, which we think we're close to seeing that, 12 months later, interest rates tend to fall by about 100 basis points. And then I do think that the disinflationary trend is going to continue. Hopefully we'll see some more signs of that tomorrow, and that should take yields lower from here. So I'm in the camp that you do see lower yields, and given where rates are right now, I think there's a very favorable risk-reward ratio for the bond market.
With regards to direction, I think you're both in the same camp right now. Some difference there on magnitude, but certainly on direction. Priya Misra, Larry Adam on the latest. Yields lower by 5 or 6 basis points. Your 10-year, 460. Coming up, the morning calls and later. BlackRock's Amanda Lynham warning of wider credit spreads. That conversation just around a corner. Your opening bell about 7 minutes away.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat-trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd! Carly Lloyd! Ladies and gentlemen, we have an American hero.
I had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
From the opening bell, let's get you some morning calls. First up, JP Morgan upgrading CSX to overweight, adding shares to their focus list due to improving volumes and easing headwinds. UBS downgrading Morgan Stanley, citing a challenging revenue environment. And finally, Berenberg cutting its LVMH price target, growing increasingly concerned about weakening sales and margins. Their stock lower by more than 5%. Up next, BlackRock's Amanda Lynham. Your opening bell just around the corner.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
you also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Post.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
We're looking for a fourth day of gains on the S&P 500. We've had 3 on the S&P, the longest daily winning streak going back to late August, and the equity market right now positive by 0.25% on the S&P. On the Nasdaq, up by about 1/3%. There's your opening bell ring, and switch on the board and get to the bond market, shaping up as follows. 10-year yields lower by 6 basis points, 4.5911 on a 10-year. Double-digit moves, yields lower, 2-year, all the way out to the 30-year in much of yesterday's session. In the FX market, the dollar weaker, euro a touch stronger, reclaiming 106 on a euro against the dollar. That currency pair 106.20, positive by 0.1%. And crude popping initially on Monday, then pulling back, down another 1.2% on WTI to 84.92. Let's keep it on energy. Exxon agreeing to buy Pioneer for about $60 billion, the largest takeover for that company in more than 2 decades. The CEO saying this: the combined capabilities of our two companies will provide long-term value creation well in excess of what either company is capable of doing on a standalone basis. Abby has more. Hey, Abby.
Hey, John. Yes, the deal is official. We, of course, reported about this possibility last week, and it is, as you mentioned, Exxon's biggest deal of the century so far. Investors not loving it, though, because right now the shares of Exxon down about 3.3%, the worst day since last week when it was speculated that this could happen. Pioneer on that day up more than 10%. So today's move to the upside a little bit muted. This month, though, John, Exxon is actually down about 9%. Its worst month since May of this year, having something to do with the oil volatility, but also as investors weigh on this deal. Now, what it gives Exxon is that Permian Basin footprint. It will more than double the footprint for that $59.5 billion. And it's easier in the Permian Basin to extract oil. So if oil, the price goes higher, ExxonMobil can almost turn it on like a faucet. Again, it's not quite as simple as that, but they can extract as opposed to having to discover. They are expecting it to generate double-digit returns by recovering more of the resource from the Permian Basin, again, because it is easier, more efficiently, and they're also saying that they can do it with a lower environmental impact. As for the possibility of regulation, CEO Scott Sheffield is saying that they do not expect any regulatory hurdles, but if you recall earlier this year, the White House had some harsh language for some of the big oil companies that the rising price of oil, that it's denting consumers. The price of Pioneer is a little more than 5% away from the purchase price, so it's close, but it maybe suggests that there could be a little bit more room for this story to develop even more, John.
There's a cushion there. There's a bit of spread, that's for sure. Abby, thank you. We're trading just a little bit higher on Pioneer, just south of 240, up by 1%. Programming note, later this hour, in about 10 minutes' time, don't miss this, the CEOs of Exxon and Pioneer live with Bloomberg's Alex Steele, a conversation you don't want to miss. Darren Woods, Scott Sheffield, just around the corner. Let's talk IPOs. Birkenstock, the long-time German shoe brand, pricing its IPO towards the middle of a marketed range to raise $1.48 billion. Simone Foxman on top of this one. Hey, Simone.
Hey, John. Yeah, this would give the company a valuation of $8.64 billion. This was, as you said, John, the middle of the range. It had been marketing $44 to $49 a share. All of this according to SEC filings. The company and the PE owner, L. Catterton, sold a total of 32 million shares, though L. Catterton will continue to control the company with 83% of the stock. But the fact that this price at the middle of the range is something a little bit different than we saw with the likes of Instacart or Arm or Klaviyo, which have not necessarily all performed well. We're looking at Klaviyo shares up about 16% since they started trading their IPO price, but Instacart trading still about 10% below its IPO price. The one key difference, however, is that Birkenstock has been profitable, turning a net profit of 103 million euros on revenue of 1.12 billion euros for the 9 months ended June 30th. So question here, both for the company as well as for the offering partners, Goldman Sachs, JP Morgan, and Morgan Stanley. Will the company be helped by Margot Robbie wearing Birkenstock shoes in Barbie? Do investors believe that there is a longer-term upside for the stock? Look out for that company to start trading today under the ticker symbol BIRK. John.
Simone, thank you. Thank you for that. Let's turn to healthcare. Dialysis providers, DaVita and Baxter, falling as Novo Nordisk's study on Ozempic's impact on kidney failure ends early. Novo writing in a statement, an independent data monitoring committee recommended halting after finding that analysis had already met preset criteria for efficacy. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, John. What we are talking about is the diabetes drug Ozempic, a class of drug that essentially mimics the GLP-1 hormone that the human body releases after eating. The question posed by the market and the sell side this morning is whether this drug can be used in place of traditional dialysis for kidney failure, or as those that are sort of more bullish on the dialysis providers, in combination with traditional dialysis. And as you point out, this independent body has said, stop the trial. It's already breached the threshold required to demonstrate its efficacy in this case. It already met the preset criteria for efficacy. Ozempic or Wegovy, they're both generically known as semaglutide. That is the kind of drug class that mimics that human hormone. It was a really big trial. It was called FLOW. Novo started this in 2019, tracking progression of kidney impairment in basically 3,500 people. So severe market response in the US and in Europe today.
Ed, thank you, sir. For the latest on this market right now, about 5 minutes into this session, your equity market more broadly on the S&P 500 looking at a fourth day of gains. We are higher by 0.4%. Want to turn to credit. BlackRock's Amanda Lynham looking into credit saying this: we see scope for a moderate rebuild of risk premia over the next few weeks in response to a mix of factors including a potential government shutdown, earnings, and the November rate decision. Amanda, I'm pleased to say, joins us now. Amanda, let's get straight into it. You wanted stability in the Treasury market before getting constructive. Does that mean lower yields or smaller moves?
Hi, good morning, Jonathan. Thank you for having me. So absolutely, credit markets and particularly spread markets were really looking for some sort of rate stability in order to stop the widening trend that had been in place up until last Friday. We got that Treasury market stability. Now, I think it's a combination of the risk-off sentiment due to the extremely unfortunate geopolitical events, some of the dovish commentary from Fed speak that you've mentioned throughout the morning, and then the fact remains that the credit markets have responded to that, and we saw a pretty significant tightening in high-yield spreads yesterday, which was the first session because of the holiday on Monday. So while early, and I would say while tentative, the spread markets are responding to the decline in Treasury yields that we've seen over the past, say, day and a half. I think the key question for spread markets is, have we seen the peak in rates? And that is really the critical view that a lot of the investors that we speak to are focused on. And then, of course, we've added a new left tail risk to the risks that we were already watching from the weekly note that you mentioned. And so that is something that we need to watch very carefully. At the current moment, high yield spreads have snapped back to 405 basis points, which is well below the post-financial crisis average. You know, we can debate whether or not that's the right period to use. But the fact remains is we're not really pricing in a lot of spread risk into the current valuations. And so I do think there's scope for spreads to move moderately wider over the next few weeks. That said, as we've discussed previously, the level of yield support in corporate credit markets is extremely attractive. So for yield-based buyers, the ability to deploy capital at pretty elevated yields relative to history, we think will provide some support for spreads and keep them in a range-bound range. And just for context, we're seeing significant demand, for example, in long-end IG spreads. And I think that's driven in part by that search for yield motive.
Amanda, lots been said about the supply backdrop in the Treasury market. Talk to me about supply of credit. Does that backdrop remain supportive into year-end?
So we did see a few deals come yesterday in the IG market. I think the performance of them on the break was mixed, but generally pretty good. I do think that corporate treasurers and CFOs will use periods of stability to take care of the refinancing risk. If nothing else, the news developments as it relates to capital management have shown us how quickly that backdrop can shift. And so I do think that in periods of stability, it behooves management teams to really get ahead of their funding needs. Much better to issue early than late or be caught out of the market. I think on the capital management front too, I think what's been striking, and you've been talking about it all morning, is the rebound in M&A. And I think it really just speaks to this trend. It's not just energy. We saw a healthcare deal announced this week as well, that companies with strong balance sheets are moving forward with their strategic plans. It's notable to me that the funding mix between those sectors has really differed. The healthcare deal that we saw this morning was funded with all cash. The energy deal was all stock. That clearly has implications for bondholders as they kind of think through capital management strategies. But I do think in this current environment of a higher cost of capital environment, that it will be, that balance sheet will be important.
We've got to talk about that all-stock energy deal. Amanda, thank you for catching up with us today. Amanda Lynham there of BlackRock, Exxon and Pioneer, the CEOs of both companies, with Alex Steele in just a moment. This was the Countdown to the Open. This is Bloomberg.
Week on AI IRL.
I do think it has a tremendously positive effect on democratizing technology. I mean, just imagine what it must feel like if you are a country in Latin America, Sub-Saharan Africa, or in other parts of the world where you just don't have either the money, because you need a considerable amount of money, or the very significant GPU computing capacity, or the data to build any of all of these things.
Of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come. I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Today's Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. ON's running shoes have a unique look, and so does its leadership team. CFO Martin Hoffman is also co-CEO, and he thinks two jobs are better than one.
How do you balance those two roles?
I feel the CFO makes you a better CEO, and the CEO makes you a better CFO.
Watch Chief Future Officer today on Bloomberg.
We welcome now our TV audience and radio listeners. I'm Alex Steele. Major news in the energy world. Exxon agreeing to buy Pioneer Natural Resources for $60 billion. And I'm joined by the two men behind the deal. Darren Woods, ExxonMobil chairman and CEO, and Scott Sheffield, Pioneer Natural Resources founder and CEO. So just in case you guys didn't know, Scott already retired once. Then he's going to retire again. And I asked him, is this time for real? Are you really going to retire? Scott, I guess this is it, right? You're definitely going to retire this time?
Yes, I'm definitely going to retire, and if I don't, my wife, I'll probably have to go through a divorce. So, Alex, I'm definitely retiring at the end of this year. We're turning over CEO to Rich Daley before we close. So Rich will still be CEO January the 1st, and then I'll be still a Pioneer director till we close, and then joining the Exxon board. We'll have 2 board seats as part of the deal.
So, Darren, you know, when I think about two companies getting together, this was like the rumored one for a while. What was the biggest sticking point, Darren, to coming to this kind of deal? Was it the price? Was it the timing? What was it for you?
So we've always said, if we're going to do a deal like this, we've got to find a proposition where the sum is greater than each of the parts, or the total is greater than the sum of each of the parts. And so it's really been focused around how do we drive unique value and value that we can then bring to Pioneer and its employees and its assets to make that combination bigger than the sum of the parts. And frankly, the work we've done over the last several years to develop leading edge technologies, the work we've done around unique development approaches, when you take the advances that we've made and then couple that with the Pioneer employees' experience and that acreage, and then the tier 1 acreage, leads to a fantastic opportunity set to recover more resources, do it cheaper, and to do it lowering emissions.
So Darren, to that point, and maybe both can speak on this, Pioneer Natural Resources in the first 2 quarters, there were productivity issues. Many analysts say that the productivity issues have been resolved and that they troughed in the second quarter, et cetera. But I'm wondering, Darren, what you can bring to basically use new juicy technology to get more new juicy oil out of the rock that's been there.
There's a lot that we can bring to that. And in fact, that's been the effort that we've had underway for 5 years now. And some of that we've implemented today. We have some unique approaches to what we call cube development, where we're drilling a number of wells to tap into the total resource and make sure that we're maximizing recoveries. We're drilling the longest laterals in the Permian, over 4 miles. We've got unique completion technology. So there's a lot of things that we've been working on that are in the field today, producing better results. And then we've got a lot of technologies that are in the pipeline or just now being deployed that we haven't seen the benefits of, but we anticipate good things. And so we can bring all that to the top tier resources that Pioneer has, and I think improve the recovery beyond what either company could do in isolation.
Yeah, 4 mile lateral. That's a whole different bag of chips there. Hey, Scott, from your perspective, you've been doing this for 40 years. People are talking about how this deal is going to kick off a Shale 3.0. Bigger companies, bigger deals, bigger, more fierce laterals. What do you think, Scott? And like, who do you think is left that's going to have to merge after this?
Yes, at the Pioneer board level, we've talked over the last 2 years. We think long-term, you have to become a diversified company. And the question is, do we do it ourselves or do we become part of a company like ExxonMobil? I really think Exxon has the best stock of all the diversified companies around the world, the best growth opportunities. And I think after this transaction that shale companies cannot survive on their own long term. They're going to have to merge up, consolidate, and be part of a diversified company is my general opinion. And this should happen over the next 5 years.
So is it going to be like private guys getting together, or is it going to have to be like what you did and really sort of reach for an Exxon that has such a huge reach all across the globe, Scott?
Yeah, there's only, as you know, there's only 2 large diversified in the majors in the U.S. that's left. You got ConocoPhillips diversified. You got Oxy that's diversified. So I think shale companies are going to have to combine and either try to do it on their own, or they're going to have to merge into one of the diversified companies. That's my general opinion of the 3 or 4 that I mentioned.
So Darren, to that point, does this merger change any investment decisions that you're going to make for stuff out of shale, like in Guyana, for example, or Brazil, Mozambique? Is it going to change you looking for acquisitions out of the U.S.?
No, I think if you look at what we're doing here, it's very aligned with our strategy. We've organized ourselves to prosecute competitively advantaged investments along different resource types. We have an unconventional business. Scott's business is a pure play unconventional business, so it slots right into our existing unconventional business. We've had the same focus on productivity and resource recovery and capital and cost efficiency. So I think there's a natural sync here. And if you look at our unconventional business and Scott's business, they're comparable sizes, so it's a merger of equals. Scott's business is basically funding itself and generating additional cash, so it's not going to need any help from the rest of our businesses. I'd expect the rest of our businesses to continue pursuing their investment portfolio and looking for additional opportunities in that space, more advantaged investments to make in those businesses.
So that feels like CEO speak for sure. We're up for mergers elsewhere too.
Well, I would tell you it's the organic opportunity set that we have. And I tell you, the business that's growing the fastest for us is a low carbon solutions business. And it surprised people, but this transaction actually benefits our low carbon solutions business as it makes available more low cost, lower carbon natural gas that we can then feed into our Gulf Coast assets, feed into our carbon, hydrogen, and ammonia plants. And so it helps on the transition side. We're also working with Scott's team. We expect to pull their net zero pledge from 2050 to 2035. So we're going to advance getting Scott's Permian organization and operations down to net zero by 2035, which is 15 years better, as we continue to advance ours to 2030.
So Scott, to that point, do you guys think you're going to get any regulatory pushback? Because I see it playing out 2 ways. One is like it's $60 billion for oil. Administration may not like that. But on the other hand, we need more oil and not rely on, say, the Saudis or Venezuela or Iran. Scott, what do you think the conversation is going to be like in D.C.?
No, we don't have downstream. The combination is less than 15% of the Permian Basin. Let me let Darren comment. His team has done a lot of work on this. And so let me shift to Darren, let him comment on the regulatory issues.
Darren, what do you think?
I think on the regulatory issues, as Scott said, if you look at the size of our business in the context of the global gas and oil markets, we're very, very small. Even in the context of the Permian, as Scott said, we're less than 15% production. From an environmental standpoint and concerns about the growth of oil, the world's going to continue to need oil and gas for some time to come. What society should be focused on are companies that can most effectively produce the oil and gas that society still needs. That's what we're doing. We're building a company with better capabilities to deliver those products with much lower carbon emissions intensity. So it's a win for the environment, because as long as it's needed, you want the most responsible operators producing it. With this combination, we will be the most responsible operators with the lowest carbon intensity and with really good plans to take us to net zero between 2030 and 2035.
I know I got to, guys, let you go because I know you have to go talk to your employees. But one more question, and it's the broader oil price. We are obviously seeing violence erupt with the Israel-Hamas war. Headlines are breaking all the time. Volatility has picked up in oil. So I want to ask you both, what do you think the new range is for oil based on all the geopolitical risks that you're seeing? Scott, go ahead.
Yeah, I think I interviewed with you 3 months ago, and I said we'll be between 80 and 100, and that's where we've been. So the big question is, does Iran and Israel, does Iran get involved in the war? It's proven that already that they knew about it. They said yes to Hamas invading Israel. So the question is, Netanyahu's got to make a tough decision. If Iran gets involved, it's going to get bigger and bigger, and it'll significantly affect oil prices.
Darren, what do you think?
I'd add, I think if you look at the macro, supply is tight versus demand, and you've seen, and that's been a function of really coming out of the pandemic and the general underinvestment across the whole of the industry. And so you've got limited spare capacity today, and what you're really seeing is prices move as demand moves, because there's not a lot of short-term capacity that can be brought into the marketplace. And so really going to be a function of demand, and any loss in supply that's out there today is going to have a big impact. And I think as long as that market stays tight, we're going to see more volatility and higher prices.
Guys, thanks a lot. I really appreciate you taking the time on such a busy day. Darren Woods, ExxonMobil Chairman and CEO, and Scott Sheffield, Pioneer Natural Resources Founder and CEO, who promises he is retiring. Thank you so very much. So that's kind of my jam. That is my news for the day. Guy Johnson, my co-host, joins me now from London. That's all I got. But I do think that the longer-term effects of this kind of merger will be huge, and sort of how you deploy the technology, how much more oil can you get out versus how much you're going to wind up spending to get it out of the rock.
Absolutely, and we seem to be moving into a new phase here, don't we, where scale and sort of power are going to really make a difference. The length of the wells that are being drilled are going to be extraordinary. Why not 4? Why not 5? Why not 6? How far do we go? And it's going to be interesting to see the power that Exxon brings to that process as it consolidates.
So it's interesting because how long you go in laterals is actually a debate that's involving in the community. So again, like you go down and then you go across. And then as you go across, you can kind of frack all the areas around it. And the longer you go, the more access to rock that you have. Now, some say, look, you got one long pipe that's a lot more efficient. Others say, but one bad thing happens at the end of the pipe and you sort of have issues then with the rest of the production. So the risk reward to that and how that plays out is definitely quite interesting.
Is this deal good for America? Does this mean more oil for America?
I don't know. I mean, America's already producing, almost 13 million barrels of oil a day. So they're already producing more than Saudi Arabia. What I wonder if it does do is kind of increase longer term, say, spare capacity. So if you get the areas of oil that's not the super juicy ones, but the tier 2, tier 3, so they're good, they're there, they got oil, but it's going to take more money, more technology to get it out. Does it increase spare capacity? And then in theory, that would be a good thing in terms of energy security. I don't know what that does to the price, but in theory, it would be a good thing, Guy.
Absolutely. Let's bring in Fernando Valle of Bloomberg Intelligence to get his take on what is happening here. Fernando, you listened to the interview. What did you make of it? What is the key takeaway from this deal?
Well, I think the key takeaway is, as you guys said, it's bringing together two majors that will actually optimize drilling in the Permian and potentially lead to higher recoveries. Shale has a very low recovery rate for the original oil in place. It started at 8% and has been climbing towards the low teens. So any small increase in that recovery rate can mean huge resources that are unlocked. So anything that Exxon can actually deliver on the $2 billion annual synergy targets that they mentioned would be really productive for the U.S.
Do you think that D.C. is going to like this deal?
I think they don't really have a leg to opine against it because of two factors.
The green stuff. Like they could say, oh, no, spend more on wind and solar or something.
Yes, but they can't dictate how companies invest at the end of the day. They're sovereign on that end, and they have a fiduciary responsibility to their shareholders. And then the second part is on the concentration. As Scott Sheffield mentioned, less than 15% of the Permian. They approved the Chevron, the Oxy Anadarko deal, and typically it's been looked at as a global business. So they're taking a very small part of global market share because oil is fungible, and we export 4 to 5 million barrels a day of oil globally. So it's of a global market as opposed to localized to the U.S.
Fernando, thanks for the update. Thanks for the instant analysis. We greatly appreciate it. Fernando Valle of Bloomberg Intelligence on the deal we've just seen announced. And fantastic interview with those two CEOs. I want to bring you up to speed what else is happening around the world. Clearly a huge focus on what is happening in the Middle East. We now understand, we've learned this over the last couple of minutes, that Israel is forming a rare emergency government. The idea here, of course, is to see the country through the war with Hamas. Let's get the latest now with Bloomberg's Anne-Marie Hordern, who joins us from Washington. Walk us through the implications of what is happening in Jerusalem and what this means ultimately for the government and its ability to take the war to into the next step, Anne-Marie.
Well, clearly this is showing that the leaders of Israel, even though they disagree deeply on a lot of political issues, Guy, you do see them rallying behind the flag. And this will be a unity government, a wartime government that is going to be focused squarely on security concerns and what Israel is calling the crushing of Hamas, potentially having an opposition leader like the ex-defense minister Benny Gantz joining in with Netanyahu. That could also dilute the influence of Netanyahu's far-right cabinet members as they draw up these battle plans. For how dramatic this is, I want to read you what the Times of Israel wrote about 40 minutes ago. They said this kind of deal would mark a dramatic, albeit temporary shift in Israeli political alignments. Previously burned by Netanyahu in a pandemic-era unity government, Gantz has been calling for the prime minister's ouster, citing his hardline coalition's embrace of extremists, his ongoing corruption trial, and the coalition push to erode judicial checks on the government. That is from the Times of Israel, talking about how dramatic of a shift this is. And you can clearly see what the focus is when it comes from Jerusalem about this unity government. This is going to be squarely a wartime government that is going to be focused on one thing only.
Anne-Marie, when we take a look at gaming this out now, what are sort of the next steps that you're going to be paying attention for, and what the international community is going to be paying attention to?
I think the biggest thing everyone is going to be focused on is this contained? Is this contained to Gaza, or is this going to start to spread? Already today, we saw fire shared between Hezbollah in the north and Lebanon with Israel. And as you see Israel drawing up and calling up 300,000 reservists, they look ready to go in for a full-on ground invasion of Gaza. What does that mean in terms of Israel being able to defend its borders elsewhere? And what does this mean in terms of the other Iranian-backed proxy groups in the region? Now, with the U.S. moving the USS Gerald R. Ford into the eastern part of the Mediterranean Sea, the Joint Chiefs of Staff has said this is a significant moment to deter Iran and Iran proxies. But obviously, the fact of whether or not this volatility, this conflict spreads, that is what people are squarely focused on, I think, here in Washington, D.C.
All right, Anne-Marie, we really appreciate it. And as a reminder, Hamas has been designated a terrorist organization by the U.S. and the EU. Anne-Marie Hordern joining us from D.C., we very much appreciate it. So here we have it. We have the macro, the geopolitical risk. We have PPI that comes in higher than estimated. We have a market that's kind of going nowhere. And then you look underneath the hood, and there are individual stories, like Exxon buying Pioneer, like LVMH getting smacked over in Europe because of weakening demand, particularly in areas like Europe. So the question of the day really is, can you actually pick stocks, Guy, in this market? Joining us now to discuss is Bloomberg's Denitsa Sakova and Abigail Doolittle. Denitsa, that's our question, right? Is it still macro that needs to dominate? Is it going to be the micro? Can you pick stocks, particularly as we head into earnings season?
Yeah, I mean, now it's a very difficult time to dissect. But what would be the best time to pick stocks? It will be when correlations are low. And this is the case for stocks. Like, implied correlations are pretty much at the lowest level.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Matt Miller and Paul Sweeney live from the Bloomberg Interactive Broker Studio. Coming up, we're going to check in with Khalid El-Gindi, Senior Fellow at the Middle East Institute, to get his latest thoughts on what is happening, the war in Israel and Israel's potential retaliation. Then we're going to check in with Fernando Valle. He's the senior energy analyst of Bloomberg Intelligence. He's going to break down this Exxon Pioneer merger, $60 billion. And Kara Murphy, CIO at Kestra Asset Management. She's going to join us and give us her thoughts on these markets. A lot coming up in this first hour. Right now, let's go to John Tucker and get a Bloomberg business.
All right, man, Paul, stock investors pretty much brushing off this morning's hotter than expected inflation data. Producer price index rose third straight increase. More policy sensitive 2-year yield. That is higher. That's up 3 basis points right now. And we just topped 5%. Also, we have 9 of the 11 major industry groups in the S&P 500 higher. Real estate and communication services leading the way. Energy, that is the biggest drag. The latest inflation data could set the stage for a rally in stocks. That's according to Ben Gutteridge at Invesco.
Our suggestion is that these inflationary trends that are in place, that inflationary pressures are abating, can continue, and coupled with some resilient growth, could be a pleasant mix for equities. certainly some unease about that positive view, but on balance, that's where we sit.
We do get the CPI, that is tomorrow. Some of the individual shares, Texas Instruments lower. Oppenheimer cut the chipmaker's rating. JP Morgan Chase, Citigroup, Wells Fargo, they're going to report third quarter results on Friday. They're also poised to write off more bad loans than they have since the early days of the pandemic. Right now, the S&P 500, 8 points higher. That's up 0.2%, 43.66 on the index. The Dow Jones Industrial Average is up 83 points. The NASDAQ 100 up 42 points. That's up 0.3%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, great stuff. Appreciate that. As always, Matt Miller, Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio. We're doing that streaming thing as well, so head over to youtube.com and search Bloomberg Radio, Bloomberg Global News. Anything like that will get you to where you need to go. Some green on the screen here, kind of a third day in a row. We'll take it. Fourth day in a row. Thank you. Very good. Very good. I forgot about Friday, since I was on the beach Friday by the afternoon. But so it's always a blur.
I get it. Well, look, yields have come down as well. We're under 460 on the 10-year, but 459.11 going out 5 significant digits. So that's a relief, I think, for equity investors. And as I would imagine, a result of that continuing drop in yields. Remember, we were at 488 and change last week for a moment. People are buying stocks.
2-year Treasury smack on that 5% number. And again, we were well north of that just a week or so ago. Let's check in with Emily Graffair. She covers all the equity markets for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker Studio. Emily, what are you looking at this morning?
Well, I'm looking at Kava Group because that stock is up almost 50% since its June IPO. And it was up as much as about 4.5% at the open this morning. The move is fading now. It's only up about 0.6%, but they got an upgrade from Morgan Stanley. Again, this is a Mediterranean fast casual restaurant.
I keep hearing about this, and people talk about the stock.
Have you not had it yet?
The ticker is CAVA as well. I have not had it yet. Is there one around here?
There's not one super close to here. There's one by Grand Central, but it's very good. I am a big fan.
Okay, let's make it.
If I had any time to go down and get lunch, to be off air,
well, at least you're not going to send me.
Tucker, go get us some lunch.
But yeah, Morgan Stanley expressing confidence in the company's catalysts. Maybe one of those includes Matt Miller starting to become a customer. They also said the near-term estimates look positive. They downgraded Portillo's, which I guess is a competitor to Kava, to equal weight from overweight.
Do you know, so the description page I always find fascinating on the Bloomberg. Kava Group Incorporated owns and operates Mediterranean fast casual restaurants. Fine. The company offers desserts, beverages, and other fast food products. No mention of entrees. Can you get a main course there?
As
you
well as
start with desserts and beverages?
The baklava is really good.
That is a great DES page. Where does that come from?
I think it comes from
it's like our most used
Hoovers.
function.
Yeah,
Okay.
I'm not 100% sure.
Producing dips, spreads, and dressings.
Yeah, but no mention of the actual food part of what they serve, which I imagine is the main, category.
The rice bowl.
All right,
lamb.
I'll talk to Tom on the 5th floor about this DES.
All right, so what else we got besides Kava Group?
Slightly related to food, I'm back on the weight loss drug impact because we talk a lot about whether the rise of Ozempic is actually going to weigh on other industries.
Yesterday I spoke with the CFO of PepsiCo, Hugh Johnson. They don't just make extremely sugary beverages. They also have like a health beverage business, and obviously they make chips, Fritos, which we love, but aren't great for us in the quantities that we consume them.
John and I were born and raised in New Jersey. Doritos is the least of our worries, given all the carcinogens.
Fritos, first of all. And the thing is, I was born and raised in Ohio, so I didn't ever just eat plain Fritos. I dipped them in actual sour cream, each individual one before eating them.
How many Superfund sites are near you?
Exactly. Well, anyway, Hugh Johnson said he doesn't see any impact of Ozempic and other Wegovy GLP-1 drugs yet. He said yet.
Today, though, dialysis providers, DaVita and Baxter International, some pretty significant price action right now. DaVita down as much as 18%, Baxter down about 6%. This was after Novo Nordisk, which is the Ozempic provider, they had a trial that showed effectiveness surprisingly early in a kidney failure trial. So whether or not it's a long-term effect, we are seeing, at least in the market right now, some of these stocks down on days like this.
Emily, thank you so much. We appreciate that. Emily Gaffredo, she covers the equity markets for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Right now, we want to get back to the story, the front page story, which is obviously what's happening in Israel. Khalid El-Gindi, senior fellow at the Middle East Institute, joins us here. Khalid, thanks so much for joining us here. We know you have so much expertise in this part of the world. I wonder if you could just, for a lot of us, we're just not sure what's happened over the last several days. Can you give us a sense of why Hamas did what they did on Saturday? Why did they do it? What was their goal, if any? And then where do we go from here?
Yeah, I mean, I can't really speak to why Hamas would carry out, such a horrific attack that has killed hundreds and hundreds, over 1,000 Israelis. I don't understand the logic behind it. I think it's totally unjustifiable. But what I can speak to is the context in which this is happening, and that is, Israel has occupied, has ruled over the Palestinians, 5 million Palestinians in a military occupation for more than half a century. Had many generations of Palestinians who've grown up without really knowing any sort of freedom. And in Gaza in particular, you have a very severe blockade that Israel has imposed that has impoverished the Gaza Strip, and most of the 2 million people who live in Gaza actually rely on international assistance for their basic needs. And so that's the context in which this is happening, as well as the sort of broader sense of despair among Palestinians that, there is no end in sight, either to Israel's occupation, which is quite violent and repressive, or to the blockade in Gaza. And so Hamas is one of the various Palestinian factions that have embraced what they call armed struggle and are determined to pursue, to push back on and resist Israeli occupation through violence. Of course, the violence that they've opted for in this case is wholly unjustified in that it's directed at civilians.
Yes, and seems to be specifically directed, according to the New York Times report on hostages this morning, at women and children as well, which doesn't make any sense. I think that those of us who've read pretty in depth about this, not nearly as much as you have. You've studied Arab studies at Georgetown and Indiana University. You've taught that at Georgetown as well, and obviously you're at the Middle East Institute. But I think we understand to some extent the context of the occupation. One thing that we have trouble divining is how much support Hamas has in Gaza and from Palestinians. And I noticed in a lot of reports, for example, in the Times today, they have a ton of coverage on this conflict. They seem to conflate Palestinians and Hamas. And I wonder how fair that is. What kind of support do you think Hamas has in Gaza?
Well, you're right. It's not fair to conflate millions of Palestinians with one movement, even if that movement is governing at the moment inside the Gaza Strip. It's impossible to say exactly how much support Hamas has. I think it has support. The West Bank and Gaza are divided both politically and geographically under different kinds of Palestinian leaderships, both still under Israeli control. I would say, people in the West Bank probably are more supportive of Hamas than people in Gaza who've lived under Hamas's governing. But at the end of the day, when something like this happens, and bear in mind that Israel's now in the midst of a very severe bombing campaign inside Gaza, where, as I said, 2 million human beings live and have nowhere to go in a very narrow strip of land, and entire neighborhoods have been leveled to the ground. So I think it's impossible to overstate the ferocity of the Israeli attack. And I think we have to be mindful that, you know, as horrific as the attacks were inside Israel, we also have to remember that there are human beings also in the Gaza Strip who are suffering and who are dying by the hundreds, and without much say in what's going on.
In fact, I read a UNICEF report this morning that estimated there are roughly 1 million children living in the Gaza Strip, meaning that almost half of the people there are, you know, UNICEF says children are people who are under the age of 15. Okay. So almost half of the people there are under the age of 15, in which case, you know, they certainly can't support Hamas. They're not capable of making that kind of decision.
So, Khalid, that kind of raises the question here. Do we have any idea, or based upon your research, do you have any idea what, other than extracting some level of retribution or revenge, does Israel, what do you think Israel's strategy is in terms of its response that we expect any day now?
Tragically, I don't think they have a strategy. I mean, what they've stated is to remove Hamas or to end Hamas's military and governing capabilities. Nobody really knows what that means. I'm certain from having talked to many Israeli officials in the past that they don't know what that means. I think right now they are in a very high state of emotion and trauma. And it is primarily the response is really one of retribution, as you said, and those are actually the words that Israeli military leaders are using, that we're not after precision, we're looking to cause damage, and we're seeing that on the ground. I think there is considerable evidence that civilians are being targeted. They're bombing neighborhoods, they're bombing infrastructure, they're bombing roads, preventing ambulances from reaching, you know, the wounded and so forth. And so it's right now emotions are running high. And so what needs to happen is there needs to be a responsible third-party actor in the international community, presumably someone like the United States that has considerable leverage, to intervene and really bring this to an end, because creating more death and destruction is not going to resolve any of the underlying issues, and in fact is just going to make things worse.
It's difficult not to be emotional about this when you read the reports of what Hamas has done. And I suppose you could say the same thing in defense of the Palestinians when you read the history of what's happened, and you could say the same thing in support of the Jews when you read the history of what's happened. So, you know, there's this back and forth. One thing I can't understand is why Iran can fund and support Hamas and Hezbollah, why they are allowed to do that, essentially, you know, promoting terrorism, why nothing is done about it. Why is Iran allowed to, reportedly they fund up to 90% of Hamas's budget, and they're pursuing enriched uranium to build a nuclear bomb. Why is that allowed, even by other Arab states?
Well, I mean, setting aside the nuclear issue, which is a whole other topic, but Iran, I mean, Iran is not an Arab state, but it is a key player in the region, and they support many different armed groups in different countries like Hezbollah in Lebanon, Houthis in Yemen, and you know, others in Iraq and in different places. Hamas is one of the groups that it supports. From Hamas's perspective, they are a non-state actor. They need support from some patron, some sponsor. Iran is a willing sponsor. Iran has an interest in opposing Israel, in creating problems for Israel. And what better way to do that than to support groups whose mission it is to attack Israel and
to eradicate Israel, to murder Jews. I mean, it's one thing to support a non-state actor, but you can't support terrorists. And Hamas, given what we've seen over the weekend, is clearly a terrorist group, right?
I mean, Hamas certainly is a group that has carried out horrific acts of terrorism. There's no question about that. These are war crimes, and they should be held accountable. Anyone involved in the planning or the sponsoring or the financing or the execution of any of these attacks should be absolutely held accountable. But I think we have to be careful in how we frame the issue. Hamas is not. Hamas is a political movement. There's no serious actor who believes that Hamas can destroy Israel.
Right.
Whatever the rhetoric comes out of any political movement.
Yep.
Rhetoric is rhetoric. If we take all political and military leaders at their rhetoric,
exactly.
then
Khaled,
it would be. Yeah.
Unfortunately, Khaled, I have to just cut it short there because of time, but we really appreciate you taking the time, sharing your thoughts with us. Khaled Al-Gindi, Senior Fellow at the Middle East Institute. This is Bloomberg.
Nordis says its blockbuster Ozempic medication showed effectiveness surprisingly early in a kidney failure trial. Now that has dialysis providers DaVita and Baxter falling. More from Bloomberg's Ed Ludlow.
The question posed by the market and the sell side this morning is whether this drug can be used in place of traditional dialysis for kidney failure, or as those that are sort of more bullish on the dialysis providers, in combination with traditional dialysis. This independent body has said, stop the trial. It's already breached the threshold required to demonstrate its efficacy in this case.
Now, DaVita right now down more than 16%. Baxter down about 9%. Novo Nordisk right now up nearly 4%. A pharmacy retail chain has a new leader. That story from Bloomberg's Courtney Donahoe.
Walgreens has named former Cigna executive Tim Wentworth to be its next CEO. Wentworth ran pharmacy benefits manager Express Scripts and led the company's $53 billion merger with Cigna back in 2018. Walgreens is looking to catch up to rival CVS.
Walgreens right now up more than 1%. Checking in with its rival CVS right now, they're up just a fraction. And Humana is changing its leadership. The health insurer has named healthcare industry veteran Jim Reckton as president and chief operating officer. Reckton joins Humana from Envision Healthcare, where he serves as president and CEO. Now, he will succeed Bruce Broussard, who will step down in the second half of 2024 after more than a decade in the role. Humana right now down about 1.5%. Those are the company stories we're following. I'm Lisa Mateo. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. The data today, producer prices rising for a third month in September. That topped all the Wall Street economists' forecasts. More inflation data tomorrow with the release of the Consumer Price Index. The 2-year Treasury yield, which is more reactive to Fed policy, that's up right now 3 basis points. We're right at 5%. But for the moment, risk assets, they're higher, kind of shrugging off the higher inflation. We have right now the S&P 500 5 points higher. That's up 0.1%, 43.63 on the index. The